Everyone, welcome to Oliver Kell's Swing Trading Masterclass. We're so excited to have you guys here, and this is going to be a really interesting morning and afternoon, as well as the rest of the webinars later on in the year. So with that, let's go ahead and talk about the disclaimer just briefly here. The content presented is for informational and educational purposes only. Nothing contained in this webinar should be construed as financial advice. Please do your own due diligence and/or contact a licensed financial advisor, as participating in the financial markets involves risk. And also, please remember that reproduction and distribution in any form of this presentation or the recording without the written permission of Traderline or Oliver Kell, is expressly prohibited. All rights reserved. And to get a little bit into the webinar series overview, here are the 4 webinars we have planned. And like Oliver mentioned, if we feel the need to add a fifth one dedicated for Q&A, we'll 100% do that. But number 1 today is Market Cycle Mastery, really kind of talking about how Oliver analyzes and interprets price action, going through all his different phases. Number 2 is more about building a great watch list, focusing in on the leaders and finding the best opportunities available in the stock market. Webinar 3 will be on the buying and selling side of things, super performance setups, and also talking about position management as well. And finally, webinar number 4 will be about building a champion mindset and also building an overall trading system. That's really important as well. So with that, let's move on here. Here's the agenda for today. First, Oliver will talk a little bit about what makes a great trading system, talking about Nicholas Darvis and how it influenced him as well. They'll move on to his market cycle, all the different stages here, reversal extension, all the way through the base and break. Then we'll really go through some exhaustive examples, QQQ, Tesla, going back a year and a half or so, NVIDIA as well, and also cover an intraday example with AMBA. And we basically imagined that the presentation side of things here will take about 1:45 to 2 hours, and also and then the Q&A will take about 30 minutes. And we plan to have a few 5-minute breaks here and there, just to make sure everybody's paying attention, refreshed, and so you can grab basically a bite to eat, something to drink, and also use the bathroom as well. So with that, let's move on here to some study tips. Definitely take notes and follow along. That's the best way to basically cement the knowledge here, do some active learning, ask questions using the Q&A section. I would very much prefer you enter your questions, anything that you have, in the Q&A section as opposed to the general chat. That just helps keep things organized here. And also, we included on the notebook that we sent you guys some homework. So definitely go ahead and fill out an analyzed chart of UPST using the market cycle and share it on Twitter for feedback. Finally, this recording will be available forever. Watch and rewatch this as many times as you want. Take notes each time. And finally, enjoy this. This is going to be a lot of fun. I know just doing the mock run-throughs with Oliver that there's so much knowledge in here, and I've learned so much. So I'm really looking forward to that. And with that said, it's my pleasure to introduce the U.S. Investing Champion of 2020, Oliver Kell, and I'll hand it over to you, Oliver.
Hey, thanks, Richard. Can you guys hear me okay? Richard, can you hear me?
Yeah, I can hear you perfectly. And we're seeing a bunch of yeses from the chat.
All right, sweet. All right, well, hey, awesome. Thanks everybody for joining. I'm flattered that, you guys think you can learn something from me, and that's really, really the goal. I hope everybody can step their trading up big time after this. First off, want to thank the Traderline guys. I wouldn't have done this without them. And I think everybody knows, Richard's a rock star. So thrilled to be doing this with him in particular. But I guess to just start things off, I kind of wanted to break things down to the simplest form as to, kind of how you should build out your trading system, right? I think we can get caught up reading all these books. You can follow people on Twitter. Everybody's saying a million different things. And next thing you know, you're following 10 different people who are all good at what they do, but they're all doing something a little bit different. And, you're just swamped in information and you don't really know what you want to do. So my advice to everybody would be to create your own system. If it looks 80% like mine or 90% like someone else's, whatever it may be, it doesn't really matter, but make it your own. And so I think the best way to do that is to focus on, okay, what are the key points to a trading system? And I think in this Darvis book, the reason I love the How I Made $2 Million in the Stock Market by Nicholas Darvis is it takes complicated concepts and simplifies them. And on page 58, he literally lines up exactly what you need to have a trading system. And it's, you got to figure out how to trade the right stocks, which I'm going to go over how I scan and what criteria I look for in the stocks that I want to trade. The right timing, which I think today, after today's session, as I go through the market cycle, I think you're going to have a better idea as to how to time and manage the position. And then I think whether you're a day trader, position trader, swing trader, whatever it is, small losses, big profits. I think by having proper timing, you're going to learn how to keep your losses small, and then having a better understanding of the price cycle, I think should hopefully give you more confidence in understanding, where your positions are, and hopefully allow you to hold them to maximize the move. So Darvis's weapons were price and volume, which I definitely incorporate those. That's the foundation of everything that I do. I don't use a ton of indicators. You'll see my charts are very clean and simple, because at the end of the day, price is sort of number one. Volume helps confirm that, and everything else, even the moving averages that I use, are all secondary to those two keys. Then Darvis uses the box theory. I kind of consider what I do to be the box theory, but maybe, on a lower time frame. I'm more intermediate term, kind of trying to catch those 4 to 12 week moves, and then I'm stepping aside for those larger bases. But I think in concept, the box theory applies definitely to what I do. And then on 58, he says he uses the automatic buy order and the stop loss sell order. I don't personally use hard stops. But with that said, I'm looking for pivots. I'm looking to build pivots and buy through those. So, somebody could, in theory, set buy orders there. And then the stop loss, I use stops on every position. I think it's vital. So I like to highlight that. Again, it's page 58 of his book, because I think that it really lays out, the foundational keys you need to create a system. So to start off, I'm just going to today's session, we're going to be going through the actual cycle. And then on session 2, we're going to look at, scanning, finding the right stocks. And then session 3, I'm going to incorporate more like the specific types of buy criteria. But I think the one really unique thing that I do is this cycle of price action. The reason I think it's important is, one, it can hopefully help you stay out of, those corrective type of environments. I know for me, when I was learning, and even sometimes still today, for sure, I can have big runs and give back during corrections. And I think if you can reduce that, you're going to significantly improve your trading, and just your, mental health during those corrections. And then 2, once we kind of get into an uptrend, I know when I was first starting to learn, sometimes maybe you took profits too soon. And part of that is because us as humans, we like security. We like to know exactly what's going on. And when we don't, we naturally want to flee to safety, right? But if this cycle can better help you understand kind of where we're at, and have, more of a comfortability, sitting in positions as they rest and pull back. And then as we get later in the cycle, maybe being more proactive in selling, and maybe that can help you hold positions. I know that's really how I use it. So the goal here is to just understand this cycle. So I'm going to run through this very quickly here. And then what we're going to do is break each step down in particular, with some of the rules that I have around each step. So to start here, I use the 10 and the 20 period exponential moving average. So the red moving average is the 10-day, and the blue moving average is the 20-day. And then you'll also see when I hop into the actual examples, I keep the 50 and the 200 period simple moving average on my charts. I get tons of questions from people, why exponential, why simple, et cetera, why not the 9-day and the 21-day or whatever it is. And my answer to that is I really just don't think it matters that much. We're truly actually trying to execute on the actual price bars, and the moving averages are a reference guide that price tends to set up around. So I'll go into that more, but let me just explain the steps and then we'll get in and break them down. So to start, at the bottom of the price cycle is what I call the reversal extension. This is typically marked by high volatility, fear in the actual market. The market's been selling off likely for a couple of weeks, and now kind of the last people who've tried to been hanging in there are scared, and they're typically hitting out. That can kind of mark the low. It's not necessarily when you really want to get involved in a particular stock, but it can be a signal to you, oh, this thing might be sold out. And then you can kind of wait for the volatility to contract, price bars to tighten up. Oftentimes that tightening happens right under the moving averages. And then when you trigger, a price pivot, which I'll get more into, and we break back up through the moving averages, you have what I call a wedge pop. So the extension is the low, high volatility. The wedge pop, you often see a decline in volatility, tightening price bars, and then push back up through those moving averages. For me, kind of triggers the beginning of what I'll call, the easy part of the trend, right? That period between the reversal extension and the wedge pop can be very up and down and unpredictable. Whereas once you kind of have that wedge pop, I think things should be a little bit more predictable, and you're more in that true intermediate term uptrend. Then the next step in the cycle for me is what I call the EMA crossback. It's pretty simple. We crossed above the moving averages, and when we test back into the moving averages, you're looking for price to support there. So kind of think of it, you get that burst higher on the wedge pop, and then you're naturally going to pull back at some point in time. And when you find support on the moving averages there, that's the crossback. So one of the things that I tell people is if you're worried you missed the wedge pop and you're, hey, did I miss the leaders, et cetera, the worst thing you can do is chase. Just be patient, wait for the crossback. It always happens. Sometimes it happens higher, sometimes it happens quicker, but just be patient because the key is to manage your risk. That's really the only thing we have control over. And that crossback can be a low risk area to try to get involved. Then the next steps from there are what I call the basin break. This can often align, coming out of a true correction, 15 or 20% correction. I think the basin break can align with some of the more traditional patterns like the cup and handle or the flat base. But in a typical, maybe a 5, 6, 8% correction, the basin break, it may be a pattern where the stock's already at new highs. But it's just a slightly longer consolidation, maybe anywhere from a week to 3 weeks, in some cases much longer. And you can have multiple basin breaks. I do think after you get 2 basin breaks, you're getting later in that intermediate term cycle. And you should start being more aware or looking for an extension. And that's the last part of the up cycle. It's what I call the exhaustion extension. And this is really the opposite of the reversal extension. It's just we're kind of seeing greed take over the market versus fear. If you're judging sentiment on things like Twitter, you'll see people just like saying this stock's going to the moon. That's when you get the rocket boosters from people. And it's basically just an extension from the 10-day moving average. It can be marked with volume just like on the downside. But it's basically just that extension, and I'll go over ways to play that more as we get more into it, and can kind of mark the top of the cycle. You don't always know it's the top until you get confirmation from the wedge drop. So the wedge drop is just when you drop back through the moving averages. Typically, you'll kind of have that pull in on the exhaustion extension with a lot of volatility. You'll kind of chop around for a couple of days, maybe a couple of weeks. Some people will think, we're going to head back to the highs, et cetera. But then when you drop back down, that's confirmation that, what, hey, if I didn't sell the exhaustion extension, I probably made a mistake, and it is what it is. But, let's listen to the market and just step aside on that wedge drop, stay out of trouble. And then on the downside, I find the downside price movements, at least in a bull market like we've been in, are going to happen much more quickly than on the upside. So let's say the upside is, 8 to 12 week move. The downside, you may have a 2 to 3 week, very quick correction where you get the wedge drop, the crossback, the basin break, the reversal extension in quick order. And then you spend as much time as the actual downside of the correction just basing out that volatility between the reversal extension and the wedge drop. So that's important to highlight. So basically after the wedge drop, you'll rally back up into the moving averages. And if price finds resistance there and heads back down, that's your EMA crossback. Then you'll have a basin break. It's typically not like a 1 to 3, 4 week type thing. Like on the upside, it might only be a couple days. And again, this is in a bull market. So in a bear market, these downside moves might be more accentuated. But, I think most people, there's positive skew to the stock market. Oftentimes we're heading higher. So the majority of what I do is focused on the long side. And then from there, after that basin break, you get the reversal extension again, and the cycle just kind of continues to repeat. So one thing I always want to highlight too is this is totally fractal. So whether you're looking at a monthly, a weekly, a daily, an hourly, 15-minute, 5-minute, if you study and go through thousands of charts on different time frames, you'll be able to see the cycle take place intraday. You'll be able to see it take place on the weekly, the daily. The one thing to highlight is you're going to have more signals on lower time frames, right? Because things are happening more quickly. You're also going to have more whipsaws on lower time frames. The cycle's not perfect. It doesn't always play out as you expect it to, but it's pretty good, and I certainly trust it. It's literally what I use. Whereas on higher time frames, you're going to have less signals. You're going to have less whipsaws. And I think that pretty much applies to all of technical analysis. If you're using the 50-period moving average, you're going to have less signals than if you're using the 20-period moving average. It's just the nature of the game. And so is what I say here is, depending on your personality and what you're comfortable with, you can look to make entries on lower timeframes that are in alignment with your higher timeframe analysis. This allows tighter stops, potentially larger position sizes, or you could take the same position size, but because you're using tighter stops intraday, maybe you take a couple shots at getting it right. So that's just one thing that I would say, and that's really kind of my goal. So my specific approach, and this is what I'm really going to be focused on as we go through this, is I use the weekly time frame for the big picture. I'm looking at weekly charts. Are we extended? Are we truly in a basing pattern, or is this just nothingness? And then my execution and trade management time frame is the daily chart. So I sort of consider this for me to be that intermediate term. And then for my executions is what I'm sort of looking at during the market hours is the hourly time frame. So I'll have the hourly up, and then specifically when I'm literally ready to go pull the trigger, it's time to buy this stock. It's at my level. It's at my moving average support, whatever it is. I'll drill down into that 15-minute time frame. There are instances where I might use the 5-minute, but overall, one of the caveats I make here below is to avoid looking at the 5 and the 15-minute time frame unless you're literally at an area that you're focused on executing. And the reason I say that is you can find trades all day long on the 5-minute chart. It'll cause over trading, and really the goal for me in my trading, because I am a chronic over trader, is to trade less. So I want to be buying and selling at areas that are telling me to buy and sell on the daily and weekly time frame, and I'm only looking at those lower time frames when I'm at those specific levels. Otherwise, literally, I don't even have them on my screen. So that's one thing I would say. And then lastly, and I think that this is a very important exercise, which I'm going to go over more on, the scanning session, but I like to highlight it, is on the weekends, I scan monthlies, and I may never trade some of the names that I'm pulling out of the monthlies. But I think it gives you a good feel for the overall market and where we're at. If we're in a correction and you're scanning monthlies and, really inclined to get aggressive when you see that reversal extension on the index. So scanning monthlies, get an overall feel for the market. More recently, just for example, I've been seeing tons of, mid and small cap banks, which I'm really not trading because I'm more focused in the tech sector. I know I get a lot of crap for that sometimes, but it's just, what I'm more comfortable with. But time frame is the daily chart. So I sort of consider this for me to be that intermediate term. And then for my executions is what I'm sort of looking at during the market hours is the hourly time frame. So I'll have the hourly up, and then specifically when I'm literally ready to go pull the trigger, it's time to buy this stock. It's at my level. It's at my moving average support, whatever it is. I'll drill down into that 15-minute time frame. There are instances where I might use the 5-minute, but overall, one of the caveats I make here below is to avoid looking at the 5 and the 15-minute time frame unless you're literally at an area that you're focused on executing. And the reason I say that is you can find trades all day long on the 5-minute chart. It'll cause over trading, and really the goal for me in my trading, because I am a chronic overtrader, is to trade less. So I want to be buying and selling at areas that are telling me to buy and sell on the daily and weekly time frame. And I'm only looking at those lower time frames when I'm at those specific levels. Otherwise, literally, I don't even have them on my screen. So that's one thing I would say. And then lastly, and I think that this is a very important exercise, which I'm going to go over more on, the scanning session, but I like to highlight it, is on the weekends, I scan monthlies, and I may never trade some of the names that I'm pulling out of the monthlies, but I think it gives you a good feel for the overall market and where we're at. If we're in a correction and you're scanning monthlies and really things look healthy, we just need a little bit more time. You're going to be more inclined to get aggressive when you see that reversal extension on the index. So scanning monthlies, get an overall feel for the market. More recently, just for example, I've been seeing tons of, mid and small cap banks, which I'm really not trading because I'm more focused in the tech sector. I know I get a lot of crap for that sometimes, but it's just, what I'm more comfortable with. But either way, it's good to know those sectors are setting up, because if something is working and is setting up, you're unlikely to just get like a waterfall decline. Now, that's not always the case, but I think it's good to just kind of see the whole market. So that's kind of a thing that I do on the weekends. Okay, so let's kind of go through each step now. So I'm going to start at the bottom of the cycle with the reversal extension. We're going to work through it. And then after that, we're going to go through a bunch of examples with live charts. So the key here is this is generally capitulation. So think fear is taken over. People are in pain. We've probably just had a couple week pullback. Sometimes in the indexes, it doesn't even look that bad. But in individual stocks, you can have people that are really, really hurting. And is what you're doing is you're looking for a defined support level on the higher time frame. So for me, with the daily chart kind of being my execution time frame or my trading time frame, I'm looking into the weekly for a support level, or maybe I'm looking oftentimes at the 200 period moving average as a support area. And when price approaches that higher time frame support level and is extended from the daily 10 period moving average, that's a key thing, is it should be extended to the downside from that moving average. you'll often get, a snapback back to the 10-day. Really, for me, I expect actually a snapback to the 20 period moving average. And that can kind of mark the quote unquote, bottoming of the cycle. So basically, you want price to be extended from the 10-day. You can see here, I say air between price and the moving average. It's kind of open to interpretation as to what that extension should be. But the key is into a higher time frame level, extended from that 10-day. You want to see heavy volume capitulation. That's just kind of like a confirming signal. You see that volume, it really shows you, oh, there's really some fear here. People probably are hitting out. And oftentimes it's the institutions who are kind of taking the other side of that trade. But heavy volume capitulation. And then if you were to actually trade this setup, which I'll talk about where I might actually trade this, but oftentimes on the daily, I'm just using it to let me know the market's bottomed. But you can look to play a reversal bar, maybe a hammer candle or something like that, with a stop below that bar. Your first profit target would be that 20 period exponential moving average. When you get there, your stops would be moved to cost. You could take partials, and then you kind of, trade the rest of your shares using discretion. But really the only time period where I actually specifically execute this trade is on the 5 or 15 minute chart. When I'm looking to play, let's say we're getting a pullback to the 20 EMA or something on the daily chart in a basin break, and I want to execute on a lower time frame. I may use this strategy on the lower time frame to actually get long. Now in the daily time frame, I'll talk about how I use it on the indexes. I use it on the indexes a little bit differently than on individual stocks. So I'm going to kind of talk about that on the end. But for an individual stock, when I see a reversal extension on the daily chart, I'm more just kind of putting in my brain, okay, this stock might be sold out. And now over the next couple of weeks, we may start to see the volatility contract, and then we may start to see it set up and build a wedge pop. I don't actually try to trade the period between the reversal extension and the wedge pop. And the reason being is you can pick the low in a stock, and it's so volatile between the reversal extension and the wedge pop that you just get shaken out. Or you're up 5% one day and you think the stock's going to keep going higher, and then it's down 4%. And then for me, I don't have the personality to handle that. So I like to just wait for the volatility to contract, and then I like to get in on the actual wedge pop. So you can kind of see an example here on the right. It doesn't really matter which chart this is. So I didn't label it. But you can see that, or actually it's SC in May of 2021. So you can see that we're extended to the downside from that red moving average, which is the 10 EMA. If we had volume on here, you could see some pretty heavy volume, and we're down into the 200 period moving average. We sort of snap back. We end up having what I call a bullish counterattack bar, that big green bar, then another inside bar. And then when you kind of break through that, it marks the wedge pop. So, you could try to pick the low and play that reversal extension. But if you wait a couple sessions, I think the trade is much easier. And you can really see it right here. Let's say that you did pick the low and it traded up, and you kind of have that tight spinning top candle. You're probably like, oh my gosh, it looks like a bear flag. And then it has a huge gap down, and you're probably a little worried about on the gap down. Whereas if you just kind of wait for that big up bar, wait for the inside bar, and then wait for the wedge pop, you can literally get in and the stock pretty much trends for you. So I find waiting for the wedge pop just makes everything a whole lot easier. So that's the reversal extension. And the actual wedge pop, which for me, this is like the money pattern. This is really what I like to play on the daily chart. For me, it's the first time the market, and when I say market or stock, I'm sort of using them interchangeably, but it's the first times we trade back up across the moving averages after a reversal extension. So the actual rules for me are price trades in a tight range as it works lower. So oftentimes you'll see this pattern build where, maybe the stock, so you've had your reversal extension, it comes back up and then it's kind of drifting lower again. And usually is what's happening there is the indexes are still correcting and they're kind of dragging that stock down. That stock may have bottomed prior to the index, but it's still setting up and building its actual buy area. So when it's kind of drifting down like that, it's oftentimes for the names that you want to be trading, it's actually showing relative strength to the underlying index as it builds its pattern. The 10 and the 20 period moving average will generally be tightening. So think about when a stock's selling off, the 10-day is extending to the downside from the 20-day as price sells off. And then as it comes back and tightens up, those moving averages will kind of come back together. I kind of look at the—
Oliver, can I hop in for a second?
Yeah.
Would you be able to use your pointer to, if you're looking at a chart, I didn't show where you're pointing?
Yeah. Sorry. Yeah, I'm sorry.
No problem.
So is what you'll see is like right here, right? You're seeing this 10-day kind of extend down from the 20-day right in here. And then this isn't like the quote unquote best example, but you'll see the 10 and the 20 start to tighten more in here when the wedge pop is actually going to take place. And then when you trigger your actual pivot, so when you recapture the 10 and 20 EMA, you want to go along with a stop below that near-term price consolidation and ride the EMAs higher. So it's kind of what we see in this specific example. We get the extension, we come up. This is what I call a bullish counterattack bar. So to me, it's just kind of like a day to take note. And then when you get this wedge, this big gap up, this actually marks the wedge pop. And that for me, we've kind of built a pivot right here. So this stays high, this stays high. This is kind of like a shakeout or, just a scum here. But once you cross here on authority, that's kind of the buy area. So I think one of the things that's sort of been lost from some people who've read my book is a lot of people think that it's just, you're trading back up through the moving averages, which that's not the case. The moving averages are a reference guide, but you always want to be trading off the actual price bars. So in this specific instance, I would create a pivot right here. And is what I'll do in the actual example, I'll be able to kind of show you the lines and how I draw the pivots, and you'll be able to see that more clearly. But just with this example, this is kind of the pivot. And when we trade through there, that's your buy area. And as we get through the moving averages, your stop would actually be this day's low. And I'll get more into that. But that's basically the wedge pop. Richard, I feel like I was a little all over the place there. So let me know how I can clarify that better.
Yeah, I think you covered the wedge pop pretty well. Could you go back to the reversal extension slide just a second? People wanted you to basically identify using the cursor the reversal extension here on SE in May 2021.
Sure. So the actual reversal extension is right here. And you don't necessarily know that until after the fact. But is what you see here, you could have thought it was right here, where you had this gap down that got bought up. But then the price action didn't fill out, right? So that wasn't it. We trade down, we go lower, and it ends up being here, but that around here when you get this wedge pop. So for me, when I'm thinking about this reversal extension, I'm looking at it on this chart and I'm saying, okay, we're getting real extended to the downside from the 10-day. And in this instance, and you'll find this a lot, that the 200 period moving average, or at least this area, ends up kind of being that higher time frame support. The reason being, stocks go on big moves, they pull back, they correct, they want to tighten up into the 200 period moving average, and they find support there. So you'll find that these reversal extensions often do find support in this range, but I'm not looking to just buy in here. Some people may. I'm waiting to see the price action set up, stable out, a bar like this where you get a big gap down, buying up, then an inside bar, then you've kind of got a pivot right here. And then that's when I'm looking to buy. And the wedge pop is confirmation that this was the reversal extension. But the key is if you can sit there and kind of say, wow, this market is really getting oversold, we're getting pretty extended to the downside, your antenna can kind of go up And you can sort of start to say, okay, I really want to start to pay attention to see if we can get some contraction, some tightening, and see if I can find a pivot to trade on. And then I'm going to talk about how I use the reversal extension a little bit differently on the indexes versus an individual stock, because I think it's real important. Sometimes when you get a reversal extension on the indexes, the leading stocks, the top names, will already be setting up their wedge pops. And I'll talk more about that at the end. But really, you just want to try to have your antenna go up when you start to see this downside volatility, if that makes any sense.
Perfect. And I saw some questions earlier about how extended below that 10 EMA do you consider extended? I know there's a lot of art to this, but could you talk about that a little bit?
Yeah, so this is going to be different for every stock. You are going to get more oversold from the 10-day, in some high flying micro cap versus, liquid growth stock like Nvidia or Tesla versus a Procter and Gamble or an Altria or something like that. So it's unique to the character of each stock. I would say for me, I am generally looking to trade, liquid growth stocks, things like a Nvidia or a Tesla. And I've never actually put a percentage threshold on it, because I'm not actually trying to trade that reversal extension. I'm just kind of taking note as to when it occurs. But you start getting, I would say, like 10% below the 10-day. I mean, that's a pretty significant stretch. And it's, you get to that area, or maybe even before that, you can kind of keep an eye out for that snapback. But there's no specific percentage. It's more something to look for, so that then you can start to keep an eye out for that contraction and look for that wedge pop.
Perfect. And going back to the wedge pop going forward, how critical is volume in determining going long in this area?
Yeah, so I get this question a lot. And the way that I answer it is, you don't necessarily need volume. However, when you do get volume, it's confirmation. And I think that the best buy areas will have volume. They may have something like a breakaway gap. I love breakaway gaps as part of the wedge pop. I think it's a key ingredient. And that's usually what kind of leads to that follow through. But it's not always there. So I will take entries without volume. However, when I see volume, it just adds confirmation. It gives me that much more confidence to maybe be aggressive in adding to the position. Whereas if I don't see much volume and it triggers and I've got it on, I might even almost be a little suspicious. Is this going to work? So it's not there's not an exact way to answer it. I would just say when you do get volume, it should give you more conviction that you got it right. And if you see follow through, you may be more aggressive in adding to your position.
Perfect. I no more specific questions on the wedge pop, and later on in the presentation, we're going to be going through some real charts, the QQQ, Tesla, Nvidia, and AMBA. So if you're still trying to put things together, don't worry. We're really going to be just repeating the same thing. Oliver will explaining it all. So don't feel like you're missing out if you don't quite get it yet. And remember, this will be 100% recorded. You'll be able to go through this and listen to his explanation as many times as you want.
Yeah. Okay. So the next step here is the EMA crossback. So this is the first retest of the moving averages following a wedge pop. So price has already recaptured the 1020 EMA on the chart. It then pulls back into that area. Unfortunately, it's not an exact science. Like, it's always going to find support on the 10-day. It's always going to find support on the 20-day. You have to use your judgment there. I mean, this is sort of a discretionary, or no, it is a discretionary system. So you want to look to buy the stocks against the 1020 EMA with your stops placed below the moving averages, but really kind of below the price bars and the pivot points that you're executing on, and raise your stops in a trailing format with the 1020 EMA. So I get people who ask me, okay, should I just put a limit order at the 10-day or limit order at the 20-day? And no, you want to look for price to show support at the moving averages. You want to see buyers show up. And there's different ways to do that. If you're an extremely aggressive trader, maybe you're looking at that area of the 1020 EMA and you're looking to execute on a lower time frame. When you start to see positive price action, you can actually use the price cycle on a lower time frame, which I'm going to show you an example of that later. Or maybe you work and you're not watching the market all day long. And as you've kind of built out your watch list, you're saying, hey, Tesla has potential to pull back to the moving averages, whatever name it may be. And when you see that daily, price bar, maybe put in a hammer candle or something like that, maybe the next day you look to execute based on follow through. So it's going to be different for each person, but no matter what, I think you want to wait for buyers to show up versus just blindly buying against one of those specific moving averages. But that's the key here is you get that pullback into the moving averages. You want to buy instead of stop below that price pivot area. So for me, when I'm kind of thinking about, how I want to hold a position, I ideally want to get my positions bought on the wedge pop or the crossback. And then as we get later into the cycle, let's say that I'm starting a new position on a basin break or something along those lines, I'm going to treat it more as a shorter term swing trade. And the reason being is we're getting later in the cycle. So I'm not going to have as good a cost as if I executed on the wedge pop or the crossback. So these are the optimal areas to get long if you want to try to hold for a multi-week move, because naturally there's going to be shakeouts and things like that. And if you have a good price, you're going to be more able to hold through that. But the next step in the cycle is the basin break. So coming off of a major correction, something like COVID or something like that, this is really where those more traditional buy areas are going to take place. And I'll show you that on Tesla, and I could show you that on a ton of different charts coming out of the COVID correction. This is going to be your handle and the cup and handle, or, your longer period, basing pattern in any type of stock. But off like a 5 or 8% correction, oftentimes that wedge pop is going to occur pretty close to the highs, and the basin break may be a shorter pattern, where you're already at new highs and, maybe it's a week long or, 2 weeks long or something like that. But really is what it is you're already above the 1020 EMA. You've already had your cross back, which is sort of a shorter pullback. And then this is another pullback into the 1020 EMA for the first time. There's a couple different ways you can try to execute it. You can be very aggressive and try to put your whole position on right against the moving averages. If you're going to do that, I recommend, using an intraday chart to try to execute. Or one of the ways that I like to try to execute it, because I like to buy in pieces, is maybe you put a portion of your position on into the moving averages, and then you add on confirmation on the actual breakout. So you'll see that I say here, buy the stock against the 1020 EMA. Stops are placed below the moving averages, raise stops in a trailing format. So this is DDOG from May of 2020. Is what we got here is we got a big gap up on earnings. So I love big gap ups. I'm going to talk about this more in the buying session. But we then kind of base out, and I find on these big gap ups and really on all buys in general, you don't want to be buying stocks that show air to the 10-day. Now, they will work sometimes. The strongest stocks I find after gap ups will take out that pivot and just run. But once you kind of get this basing, in my eyes, you're likely going to have price test the 10-day and often the 20-day. So you generally want to wait for that to happen, or you're more likely to, buy too early and get shooken out. So once we kind of catch these moving averages catch up after this basing period, the real true buy area is through here. But you could be looking to start a partial position in against the moving averages here. I only start a partial in here just because you can kind of see it's still choppy yet, and the stock hasn't really put in that day to take note bar, which we get right here. So this is the true breakout. So if you were looking to build in here, just small partials. You could add on this breakout bar, and then you would have your stop definitely below this pivot, and maybe even below the breakout day low, just kind of depending on your conviction on the trade. And then you're looking to ride the moving averages higher. And you can get multiple basin breaks. I think in the COVID run, we saw, you had stocks that maybe put in 4 or 5 basin breaks. But I think in a typical environment, once you get 2 basin breaks, you should probably start to realize you're getting a little bit later in that intermediate term cycle. So if you just kind of think about how earnings are there every quarter, right? Every 12 weeks. So a swing trader like me, often that earnings cycle can kind of, affect the actual trend, right? And you might have 2 basin breaks and you're 10 weeks into the cycle, and then you want to start to potentially look for that exhaustion extension.
Oliver, before you move on, there are a few
Yeah,
questions about the crossback and the basin break. Could you go back to
sure.
the crossback slide? The first thing people wanted you to identify on the chart exactly where the crossback is, if you could do that.
Sure. So again, the crossback, similar to, the wedge popping thing, it's not a specific pattern. It's more a step in the cycle. So it's really like all in this range right in here. So
And
it's
Oliver, sorry to jump in. Could you activate your laser pointer? That might be clearer for people to see. If you go down to tools on the left-hand side.
tools.
It pops up when you put your cursor over near there on the screen. Top bottom left.
Annotate.
I think if you go to the left-hand side, the bottom of the screen, it should just kind of pop up on the screen. Annotate could work. You can use that if that's good with you.
Let's see here.
And while you're doing that, I'll see if there's any questions here. Like we said, we're going to be going through a ton of examples, so don't feel like you're missing something. And let's see. If you can't figure it out, just your cursor, I was able to see it fine, so that's perfectly okay.
Okay, well, yeah, here we go. All right, so like this area right in here is the crossback. So the wedge pop to me on this specific chart is right here.
Mm-hmm.
We kind of build our price pivot here. We trade up. This is sort of a unique situation that we're trading up into the 50 and 200 period moving average. So that's pretty quick resistance. I think you generally want to try to be trading stocks above these moving averages. But this is off the COVID lows, and just most stocks were pretty beat up.
Right.
So we go up and we pull back, right? And this area in here is the crossback. So similar to the basin break, you can look to, start partials in here against the moving averages. And then you want to add kind of when we exit this congestion area. So, if you started in here and probably added in this area, or, maybe even added in here, this would be kind of your stop area down here. And then it's still a little choppy in here, but you can see we hold these moving averages. I think because we're below this 50 and 200, it's part of the reason it's choppy. But as you get this pullback here, and then we reconfirm, you would raise your stops to here, and then you're kind of getting lift off, and you're into that uptrend. But this crossback does hold, very well. It's just the one funky thing here is if you put too big of a position on here, you kind of get your pivot tested. It does hold, but that's part of why I like to buy in pieces, is because you can kind of sustain that little bit of chop around the buy area, if that makes sense.
Yeah, absolutely. And another question people had was what are the differences between a basin break and an EMA crossback? It's kind of the length of the consolidation. Is that right?
Yeah, but really, so like one of the things I want people to understand is like the crossback and all these things. They're more like steps in the cycle to kind of help you mentally understand where we are in that intermediate term move. So more than just like oftentimes the crossback, in a more typical environment, in a shorter term correction where you're not below these moving averages, it might be like literally you go up and it's like a 2 to 3 day bull flag and we bust out of it and it's a lot smoother. But it's more where we're at, right? So the wedge pop, we retake it. We're near the beginning of the trend. The crossback is that first test of the moving average. We're still probably in the front third of the trend. Maybe we're getting to the midway point. But then once you get to the basin break, you're getting further into the trend. You get a second basin break. You're getting pretty far into the trend. It's more kind of understanding where we are in that intermediate turn trend, because that's going to affect how you manage the position. So for example, if I'm buying a crossback, I'm going to be more likely to hold a stock through pullbacks. Whereas if I'm on like the second basin break, I'm going to be more likely to be taking a quicker swing trade, sell into strength, because I know that we're later in the cycle. So that's how I think you should think about it. And then I'm going to go through like specific actual buy patterns from an execution perspective. So when you think about this session today, I think you really want to think about like the steps of the cycle, where we're at, and how that can help you, manage positions that you're in. So think about the crossback as just earlier in the cycle, first test the moving averages. Basin breaks are just, later steps in the cycle. And as you get more basin breaks, you want to start to be more aggressive in selling into strength versus, holding through those resting bars and those consolidations.
Perfect. I think that answers the most of the questions that that I'm getting. And yeah, just to point out, Lee says, great explanation. Right. This session is not really about buying or execution. We're talking about the overall price cycle, and webinar 3 will be a lot more about buying setups, position management, stop loss management, all those type of things.
Yeah. So today, I really want people to internalize the different steps of the cycle.
Right.
Because if you kind of understand where you're at in the cycle, it can better help you execute. It can better help you say, hey, this is a bull flag I want to play. Whereas, if the indexes are blowing off and you see a bull flag on a chart and it looks really good in isolation, you probably want to avoid that because you're late cycle and it might fail. So understanding where we're at in the cycle is key. And then it'll better help you, analyze a specific buy area on a chart and whether or not you want to take it.
Perfect. I think we can move on.
Okay. What's going on here?
And yeah, everybody keep dropping your questions in the Q&A section. That way I can keep everything organized and instead of the chat, which is a little bit messier. And if we don't get to your question, don't worry. We'll kind of be answering the most asked questions on the website, and we'll have a Q&A section there. So with that, go ahead, Oliver.
Yeah. Okay. So the exhaustion extension. This is blow off euphoria. It's a sign that the market may be topping. It's exemplified by prices extended from the 10-period exponential moving average to an unsustainable level. The further you get into an uptrend and the more extensions you get away from the 10 EMA, the more likely a stock is to rebase. So hold on, Richard. Let me, my old markings.
No problem.
Are on here. The second one thing I highlight here, which this is something that I really studied after 2020, and I really wanted to know, when are these extensions more likely to lead to a pullback, and when are they more likely to lead to a new base? So the second extension from the 10-period exponential moving average is generally a good place to take profits. And if you get a third extension, you're sort of playing with fire, in my experience. And we did see some third extensions in 2020. In 2021, there's been situations where we actually haven't even had a second extension, just because trends haven't followed through as well as they did in 2020. But I think is really what you want to be looking at is you get extended from the 10-week EMA on the weekly chart, your kind of antenna should go up. Hey, we're extended from the 10 week. The 10 week to me is more of a longer term moving average. And then if you're looking at your daily chart and you're looking at it and saying, hey, we're having a second extension from the daily 10 EMA, it's, for me, you want to, at least in my opinion, be taking partial profits at a minimum. And for me, I've come to the point where I'm more likely to just take my position. And the reason for that is you may not be selling the top. Stock can always go higher, right? But I find that once you get that second extension, the volatility is going to start to increase. So you may get like a swift pullback and then you go up and make new highs. But for me, I start to find it difficult to hold through the pullbacks because they become sharper, the price bars become wider. And it's just because you're getting later into that intermediate term trend. So I find selling that second daily extension, especially when it's confirmed by an extension from the weekly 10 week, to be a good area to start to reduce and take some risk off the table. And are you always going to be right? No, it's just the way it is. Stocks can go higher, you make mistakes. But I think over time, it's going to help improve your trading by taking into these extensions into strength. For me, I know it can definitely reduce stress when you get those swift pullbacks after the second extension. And this doesn't always mark a top in a stock, definitely not. But I find after that second extension, you will get a longer period of basing, rather than maybe like a 1 to 2 week pullback and a basin break and head higher. Maybe you get a whole new base, where you come back and you test the 50-day and you build maybe a 6 to 8 week consolidation. And I don't have the personality to hold through those bases. And you know what? The best stocks, they really don't correct that much. And sometimes you're buying them back, 4 weeks later, 5 weeks later, right where you sold them. And I'm fine with that just because that's my personality. I'm not good at holding through that multi-week consolidation. So for me, that's the top of the cycle. Richard, are there any questions there before I kind of go through the down cycle?
Yeah, there's a question about I think just if you could talk a little bit more about using different time frames and looking at these exhaustion extensions on different time frames. I think this is a really, really key point, and basically taking that into account in terms of how extended are you in the move and how long might be the consolidation coming up after it.
Sure. So I think this will make more sense when I start going through the examples. But I think in its simplest form, the way that I really think about it is if I start to see a stock show air to the 10-week moving average, so I'm talking the weekly time frame, and on the weekly it can be the first extension. But if I start to see a second extension on the weekly, I'm going to be definitely even more aggressive in taking profits on the daily. But really, I'm looking for a price to get extended from the 10 week. And then when I see that, I'm looking to be more aggressive in taking profits on daily extensions. And I think when we go through the examples, it'll be easier for me to explain that. But I think that's kind of the key concept. Extended from the weekly 10 EMA. Okay, I'm aware of that, but we're trading on the daily, right? But I'm aware we're extended on the weekly. And then when I get that second extension on the daily, I've got the weekly extended. Now I got the daily extended. So you may have people who trade off the weekly start to be reducing their positions. And then you've got people on the daily who are looking to sell into strength. So you kind of got two groups of people. And for me, that's what I'm mostly looking at. And then I'll show some examples where when you get a second extension on the weekly, which happens, usually you get that first extension on the weekly and then you rebase, and then you start to run again and you get that second extension on the weekly. And then that's usually when you actually start to get those bigger corrections because, the market's moved pretty far twice. So you get a second extension on the weekly, that should really, really start to make you think, okay, we're getting more. I hate to call it later stage because it doesn't always mark a top, but from an intermediate term swing trading perspective, um, the odds are you're going to have more of a pullback or a correction.
Right. And I thought this is a really good question from John. Do true market leaders often behave as exceptions? For instance, do they have more extensions, or do they still seem to fall within the 2 to 3 extensions based on your experience?
So I like to think that I'm always trading the true market leaders. That's not always the case, but I like to think that I am. And I think that you are more likely to get maybe a third extension on a name that's like ridiculously strong. But I still do think after that second extension, the volatility is fairly elevated, and they become harder to trade. Now, the one thing that I would say, and I think, for me at least this year, I've seen it in names like Asana and UPST, is, you could sell that second extension and the stock, may pull back, a little bit, maybe let's say it pulls back, 5% below where you sold or something, but it never really has like a major pullback. And then next thing you know, 2 weeks later, you're buying it back, like, right where you sold it. Or sometimes maybe even, a couple points higher. And for me, that's just how it is. The strongest stocks, for example, let's say you have a ridiculously strong stock and, the market goes into a correction, but that stock, rather than build a huge base, maybe it builds, the IBD 3 weeks tight, right? And it only has like a 10% pullback from, top to bottom of its base. And maybe you sold it, 5% off the highs or something. And, now you're sitting there and it didn't really correct. And for me, that's just like no trading system's perfect. And I have no issue buying a stock back higher than where I sold it. I view it as like a new trade, and it is what it is. So that's not the perfect answer to your question. I guess is what I would say is the strongest names will generally not pull back as much. But the thing is, you don't know what a name's going to do until after the fact. So I'm happy to sell that second extension. And you know what? If I have to buy it back higher, it's just how it goes.
Perfect. Oliver, do you want to? We've been going for an hour. Do you want to take a maybe 5 minute break, and then we'll
Well,
resume for the next slide, or do you want to finish out the slides first?
yeah, let's finish the down cycle real quick because I can go through it much more quickly, and
Cool.
then knock out some examples. So I'm mostly focused on the long side of the market for the most part, but I do think it's important to be able to identify the cycle in a downtrend because it's going to allow you to kind of strike when the market starts to turn. So basically, you have your wedge drop, and it's important to recognize a wedge drop. And the reason I say that is you're not always going to sell that exhaustion extension, unfortunately. Like, right, we're all perfect. No, not the case. If you miss that exhaustion extension, and you want to be stubborn and, tell yourself, hey, this is rebasing and it's going to head higher. You can tell yourself all you want that that's the case. But once you get that wedge drop, it's confirmation that the exhaustion extension happened. And in my opinion, you got to just admit that you misanalyzed it and take your position. So the wedge drop is the first time the market trades back down below the moving averages after an exhaustion extension. It serves as confirmation that a stock has topped or at least needs to rebase. And again, I hate to say top because it could just be rebase. But basically, you can see here on the left, it's, we had our exhaustion extension up here. Then price trades in a range, it might work higher. So for example, this is Zoom at its top, and you can truly see if you go analyze the weekly and the daily, this was a second extension. You had a shooting star here, and this was the exhaustion extension. We came back down. We kind of found support on the moving averages, right? And, maybe you're thinking through here, oh, we're going to head higher, and then they gap it up and sell it. And right here, when we lose this, if you thought we were going to rebase here and everything, Now is where the market is literally telling you that this was the exhaustion extension, because we're breaking back below the moving averages. We're triggering this. And if you are a person who likes to short sell, this is an area right here where you could look to take the market shorts. You could short through here. You could put a stop above this consolidation right here, or if you're more aggressive with your stops, you could put it right here. I think if you are going to short, the best opportunities to short are when you have a second extension on the weekly time period, because those are the situations where you're more likely to see a stock really come in versus just kind of be choppy and base around and reset up. So that's what I would say is a key, is short situations where you have two extensions on the weekly versus just one extension on the weekly. So, go short with a stop above the near-term price consolidation, or a lot of the time I use the trigger bars day high. And then you want to ride the EMAs as a trailing stop once the trade triggers. And then you'll have your EMA crossback, which is really just the same thing, but on the downside. So price already lost the 1020 EMA. It then rallies back up. So you can see we rallied back up. In this instance, we get a big gap that gets sold. And then it's kind of confirmation when you trade below this area. But you could short the stock here against the 1020 EMA and stops placed above the moving average. Me personally, I'm a little less inclined to short beyond that initial wedge drop, just because I try to be really, really careful not shorting late, because you can really get your butt handed to you. But if you have very high conviction something's going to roll over, you can take this trade, stops placed above the moving averages, and lower them with the 1020 EMA. Then you get your basin break. Price will build a basing pattern, finding resistance at the 1020 EMA, short against the moving average with confirmation adds on the base breakdown. One thing I'll say is downside movements, the old saying, you take the stairs up and the elevator down. For me, the basin break here in Tesla is like right here. And you can see we never really even get up to test the moving averages. Just because when markets want to sell, when people are scared, price just doesn't rally back. It's not as uniform as on the upside. So I'm not the type of person who's looking to short basin breaks really on the downside, because I find it difficult to manage your risk. You can short in here, and it's not uncommon in a downtrend for the stock to squeeze back up and then like roll back over. I find it easier if you don't get it right at the beginning to just be patient and kind of sit out. And then so that's the basin break, and then you get your reversal extension. You go back through the cycle again. So Richard, one thing I wanted to touch on right here first is how to use the index, because I said earlier that I use the index a little bit differently than individual stocks. Now, the index actually goes through the price cycle very uniformly, in my opinion, but analyzing the index should better help you execute your individual stocks. So is what I mean by that. And I'm talking specifically here about like the Qs or the spiders. But as discussed, you'll see volatility at turning points. So markets often top and bottom on an expansion in volatility, and then you get a contraction in volatility prior to a future sustainable move. So you want to start to see that contraction before you get aggressive, because you can just have whipsaw back and forth with high volatility, and it's difficult to trade. But here's the caveat. Leading stocks will often break out or start to move before the index have their true wedge pop, right? And it's what I mean by that is the index could be having a reversal extension and putting in its low, but some of the best names will actually start having their wedge pops as the index is putting in that low. So if you're able to kind of anticipate and see that the index is putting in an extension to the downside, and then you start to see individual stocks with setups, those are setups that you can take. And really the way that you want to get exposure to the market, in my opinion, coming off a correction, is, maybe you get your one or two names going when the index kind of put in their reversal extension. And then you want to look to add exposure over the next few weeks between the reversal extension and the ensuing wedge pop. So maybe you get one or two stocks going on the lows in the index. If they start to work for you, you can look for another stock or two. If those start to work for you, you can continue to add exposure. And so one of the things that I pay attention to is after the wedge pop on the index. So I'm talking not your individual stocks, but the actual index puts in its wedge pop. A good way to judge relative strength is to make sure you're playing names that are ahead of the index in the cycle. So for example, if I see the index put in a wedge pop and then it has an EMA crossback, I don't want to be getting in stocks that are showing a wedge pop when the index has an EMA crossback. Why? They're behind the index. They're laggards. You're playing them because you missed the leaders, and you're probably a little frustrated. And like, look, guys, I'm there all the time. Like, it happens, but you're not playing the best stocks in the market if you're playing stocks that are behind the index in the cycle. If the index has a wedge pop, you want to be looking for stocks that have a crossback or a basin break. If the index has a crossback, you want to be looking for stocks that at a minimum are having a crossback and hopefully are basing on the highs and ready to blow higher. That's a way that you can assure you're trading names that are stronger than the underlying index and are hopefully going to outperform and have higher percentage up days than the index. And then, so one thing I say down here, at least I think I say, so I pretty much just said that. A lot of the time, by the time the index has a wedge pop, and often that can, sort of be aligned with, the quote unquote follow through day, you want to already be positioned. And if you're not, that's okay. But if you are, it's going to allow you to better handle, natural pullbacks in the market, and hold your names for multiple weeks. Now, if for whatever reason you miss the ideal buy areas, that's okay. I mean, look, nobody's perfect, but you just want to be cognizant of that and be patient and wait for good setups, wait for pullbacks, rather than chasing stocks higher. And then just the other thing I'll say is when you get a wedge drop on the indexes, and we're going to show some scenarios of, in my opinion, obvious exhaustion extensions. You want to kind of throw your correction rules on, whatever they may be. Everybody has different rules. Sort of a rule I have, I call it the 30% rule. And when I really determine that the indexes are in a correction, I try to make sure that I'm trading 30% of my account or less. And really, I don't even really want to be taking overnights. Because oftentimes in corrections, you'll have like a big gap down, the market will trade higher during the day, and you start to have some traction on some names, but then they gap it down the next day and you give back everything. So I think it's better to have rules to stay out of the market until you start to see that index reversal extension and wedge pops and other setups building on individual names. So any questions on that, Richard?
Perfect. Yeah. There's a quick question. What index do you usually look at in order to determine that trend and where it's in within its cycle?
Yeah, so I mostly use the NASDAQ because I trade a lot of, more techie growth type stocks. If you were the type of person who liked to trade more cyclical stocks, things like the financials or oils or whatever it may be, I would more likely use the S&P. Just because I think that's going to be more reflective of the names you're trading. With that said, who knows if I start trading more cyclical names, who knows? I would probably start using the S&P, but I use the NASDAQ because that's more reflective of growth stocks to me.
Perfect. I think this is a good stopping point. I think I've seen a couple requests for a break. So we obviously know there's a lot of material being thrown at you. That's why these are recorded. They'll be available for you to watch as many times as you want. And with that, Oliver, is this a good spot to take a 5-minute break before we get into the examples?
Yeah, I think this is a good spot. So maybe, what do you think, Richard? Take like 5 minutes or something like that.
Yeah, it's about 12:30 right now, so we'll come back and get going around 12:35 or so.
Okay. All right. Perfect. I'll see you guys in a couple minutes.
Cool. And there's some questions about relative strength. I'll just answer that quickly. If you don't know what relative strength is, it's basically a concept shared by um, the CanSlim crowd. It's basically outperformance versus the index. So there's a bunch of ways to determine it, but you can, if the overall index is below the 21 or the 20 EMA, like what Oliver uses, and a stock is holding up above that, that's one way to determine relative strength. Also, just the RS rating for MarketSmith is another way.
Yeah, and on the buy session, I'm
Yeah.
going to be spending a lot of time on relative strength and
Awesome.
ways to
Awesome.
identify it because it's one of the key tools in trading the right stocks.
Perfect. All right. We'll see you back in about 5 minutes. Thanks. I think we're good to get going, Oliver, whenever you are. And just to introduce this, we'll now be going through some in-depth examples. So I know some people had some comments about the charts on the slides were kind of hard to see. We'll now be going through some full examples, walking through the price cycle on QQQ, Tesla, Nvidia, and also an intraday example on AMBA. So this is really my favorite part, doing the mock run-throughs. This was where it really kind of clicked for me, and I'm sure you guys will get a ton out of this.
Okay, awesome. So, Richard, can you guys see the chart now?
Yep.
Okay, all right, perfect. All right, so Richard kind of just set the stage, but it's what I'm going to do here is I'm going to walk through the QQQ. So this is an ETF for the NASDAQ index, and it is the index that I mostly pay attention to. And I think kind of understanding the different steps of the index, like I said before, is going to hopefully help you better, execute your individual stocks. So what I'm going to do is I'm going to kind of look at the top leading into the COVID correction, and then we're going to work all the way through to literally right now. And I'm going to tell you where I think we're at right now, and maybe what could happen going forward. We'll see. But so everybody can kind of see we lost this trend line on the NASDAQ, and we just blew open, right? Very easy to see after the fact. But how could we have seen it, before this happened? How could we be right here and maybe be on alert that we could get some sort of correction? So the first thing that I want to look at here is the weekly chart. So we're just looking.
And Oliver, just to jump in before you get too far, maybe give a brief overview of your chart layout, what moving averages you're using, and all of that, just so everybody's clear.
Yeah. I'm sorry. And guys, like, definitely ask questions. I'm not seeing all the questions, but I can get on a roll and I can talk about this stuff all day. So let me know, if I'm not explaining something well enough. So is what I've got on my charts. I keep everything super simple. I don't like to clog my charts up with a bunch of junk. Or sorry, I shouldn't say junk. There's a ton of ways to make money in the market, but for me, is what I do is I have the 10-period exponential moving average. This is the red moving average. I have the 20-period exponential moving average, this blue line. I have the 50 SMA, which is this green line. And then I have the 200-period simple moving average, which is this orange line. Sometimes on individual stocks only, not the index, but sometimes on what I consider to be extremely fast moving stocks, I will add a teal moving average, which is the 5-period exponential moving average. But I sort of use my judgment as to when I'm going to do that. And then below here is I have volume. I actually normally do not color code the volume. I think a lot of people like to see the color coded volume. But the reason I don't color code it normally is because I'm more just interested in the amount of volume. And then I'm going to look at the price bars to, mentally come to the conclusion whether I think that's good or bad volume. But the green bars represent, days where the the market was green, and that's the volume, and then the red bars represent when the market was down, and that's red volume. So I truly do follow the Darvis, price and volume. I think if you were to ask me what is everything in your trading system, it's price, volume, moving averages as a reference, and chart patterns, and that's what I use. Okay.
And Oliver, sorry to jump in again. I'm sure some people are wondering, how did you decide on these time frames, and how much of a difference does it make, the 21 EMA versus the 20 EMA, that type of thing?
Sure. So great question. People ask me this all the time, hey, the Fibonacci's are 8 and 21, they're so much better than the 10 and 20 day, whatever. I don't think it really matters what moving averages you use. If you want to have the 8 day and the 21, or if you want to use the 9 day, whatever it is fine, because the moving averages are a reference guide, right? You want to be trading price. Price is what is most important, and you want to be using your moving averages to help you better trade price. I'll just use a rand. This dips a little below the 20 day, maybe the 21 day worked better here. But maybe the 20 day worked better here than the 21 day. So you want to be careful to try to, quote unquote, over optimize exactly what it is you're using. So I don't think it matters specifically what moving averages you're using, because we're using them as a reference guide.
Perfect. Yeah, I think that answers it. And one more thing quickly. I did want to mention, just in terms of the time of the webinar, I saw some questions about that. We imagine that the presentation, including the charting section, will last about 2 hours, and then we'll have some dedicated time just answering any questions you guys have for about 30 minutes after that, as long as we really need to. So just to clarify that, and Oliver, take it away.
Yeah. And look, like I said before, if you have to go and you need to rewatch this or something, and you're worried your question's not going to get answered, we'll do a whole nother session of Q&A. Like,
For sure.
We're going to make sure everybody gets everything answered. And I tend to talk too much. So, all right. So let's look at this top here, and, how could we have maybe seen this coming? And I think the key here is in the COVID top is actually to look at the weekly. So what I'm going to do is just zoom out to right here. We had this big weekly basing pattern. We, broke out. You had, one major shakeout here. But to me, you kind of get an extension here from the weekly. So if you look 213, you're about 10% from the 10-week moving average, which is pretty far. And really at the highs, you're even more than that. You're 6 or 7%. And then we pull back, and then we're actually in the process at the top here, of putting in a second extension where you're about 7 or 8% from the 10-week. And I would say 7% from the 10-week is definitely sort of like a mental, over 7%. That's like a mental area for me where I want to pay attention. And then I would say in the daily time period, I would say kind of 5% from the 10-day is sort of a mental level for me. So again, not an exact science, but those are sort of thresholds. But we're putting in a second extension on the weekly here. So without knowing anything of what's coming next, it's reasonable to conclude, hey, we're not in the early stages, right? Now, that doesn't mean you think there's going to be a big sell-off. I mean, most of the time here, I think we're probably going to put in a little 5% correction, let the 10-week catch up and rebase and go higher, right? Because we're in an uptrend. But that's kind of my point, in that I like to just kind of pay attention to whether we're in the first or second weekly extension, because it can kind of lead to better understanding how deep the correction might be when it happens. With that said, I don't think anybody could have known this was going to happen. But basically, we have that second extension on the weekly. We put in a big pullback candle here. We kind of find support on the 10-day. But then a big thing here is we have what I call a downside wick play. So we actually gap down here, and we don't fill the gap, which is a sign of weakness, right? They gap it down, and really the buyers couldn't step in at all. And I think gaps are a great tool to kind of indicate what's coming next. So an unfilled gap down is a sign of weakness. An unfilled gap up is a sign of strength. And when you lose this wick low with a gap down, this is what I call a downside wick. And to me, in this instance, because we're extended from the 10-week for the second time, you could call this your wedge drop. In reality, this actually signals your wedge drop. But if you were to go back and look at a lot of stocks around this top, most names had actually started to stop out on this day and this day. And I was actually 100% cash on this day, not necessarily because of the index, but because I think a lot of stocks had started to stop out prior to this. But either way, you get this downside wick. And to me, this is definitely something to take note of because of how extended we are on the weekly. But the true marking of the wedge drop is here. And I think the size of this gap and the fact that we barely rallied to attempt to close it should be a huge indication to you that there's a lot of weakness here. It's hard to, analyze the market in real time and maybe recognize this, but think about the fact 2 unfilled gaps. This is a huge unfilled gap. And when you take out this day's low here, you're now losing the 50-day. You have 2 unfilled gaps. This is like definitely the wedge drop, whether you consider it here or here. We're clearly in a down cycle to me at this point. And whether you got out a little late or got stopped out of everything early, to me at this point, it's irrelevant. Your correction rules should be going into effect because we're actually making a lower low at this point on the index for the first time. So the wedge drop's in effect. And to me, we come down like pretty severe decline. You start to
Oliver,
see.
can I jump in for a second?
Yeah.
There's a question about the unfilled gaps. How would you define an unfilled gap, and how long does this have to stay unfilled for it to be in effect? And someone also pointed out the change in volume here, along with the wedge drop and that negative price action.
Exactly. Great call here on the change in volume. I mean, look at the volume one on this break. It's higher than all these previous 10 bars. But really this day too, when we have the downside wick, I mean, this is the highest volume on the chart. You literally can't see a bar of higher volume this entire up move. So definitely confirmation. Just another, downside gap unfilled and confirmation. So as far as gaps filling, it's not an exact science. I would say when you get a gap with other confirming indicators like volume and understanding where we are within context on the weekly, second extension on the weekly, it just lends the fact to the idea that this could be, sort of a breakaway gap, which is what it ends up being. I find if gaps don't fill within a day or two, let's say we traded down and back up and filled it, it wouldn't have a lot of significance for me. If we gapped down and filled it and then traded down, it wouldn't have as much significance to me. But when it unfills and then you get a follow through gap down, that's where you should really be saying, holy smokes, we got some real weakness under the hood here. It's being confirmed by the second gap down. It's being confirmed by the volume we're seeing on this price break, and understanding where we are on the weekly, that should all come into play as to how you treat the market here. Okay. Okay. So that is what we get here is we come down and we do test this 200 SMA. So for me, and is what I think about downside corrections is the price cycle happens much more quickly. So you could even say like this represents the crossback, this is the base and break, and this is a reversal extension here. And that's fine to say that. But the reason I don't play the reversal extension from a buying perspective is you don't know that it's the reversal extension until after the fact. So is what we end up seeing here is we rally back up and we find resistance at the moving averages. And the way we find resistance and truly build, to me, a negative pattern is a sign that this is unlikely the extension. But is what we end up getting is confirmation that it's not when we take out those lows. So to me, this is the crossback. So we rallied back up to the moving averages. And then this little mini pattern here is the basin break. So you can see it's, it's more 2 or 3 days versus like a multi-week pattern to the upside. And then you're starting, to me, to get into true reversal extension type areas. Like, look at the volatility here. Very oversold. I mean, this is literally like an 8% up bar. Like, that's crazy, which is why it's difficult to start playing in here until you start to see volatility contract, because what happens the next day, we actually take out the lows again, and we have like literally a 10% down bar. Just insanity. Like, I don't know how anybody can trade this other than somebody who's a skilled day trader, really executing intraday. So the key is to just wait. I mean, you need to wait for the volatility to contract and for patterns to build. You're going to have no patterns on underlying stocks when stuff like this is going on. You're just not. However, the strongest stocks that are resisting the selling, or they're selling less than the market, those are the names you want to be starting to build a watch list of. And as you get deeper into this correction, hopefully you can be identifying more names that are kind of selling off, because I think in a correction like this, that's this extreme, just about every single name sold off. But as you get deeper into the correction, you'll start to see some names that start to resist the selling more than others. And then the names that are just selling aggressively with the index, those are likely names that you don't really want to be paying attention to. You want to find the names that are starting to resist the selling. And I think in this area here, a couple hints that downside momentum is running out. We take out the lows here and we rally back up. We then take out the lows here and we rally back up. So is this a sign to step in and buy the market? Absolutely not. But it is a sign that sellers are kind of, losing momentum to the downside. You see it again here. This is kind of the third move down where buyers kind of step in. And then what happens? We get a big gap up. And so this is kind of a sign, is the momentum changing here? And we sort of follow through here. And to me, you could kind of look at this as a potential wedge pop. The reason why I think you probably want to wait is look how extended the 10-day is from the 20-day. You still have extreme volatility. And to me, this wasn't a wedge pop because of that. But you come up, you kind of come down, and is what we started to see in this area on a lot of individual stocks is you started to see real patterns being built. And actually on this day right here, you started to see a lot of stocks breaking out and starting to head higher and trigger patterns. And to me, that's like the best indicator you can have is individual stocks, what they're doing. Are they breaking out? Because that is going to be the key thing for you. This was such an extreme correction that there weren't actually, in my opinion, a lot of stocks breaking out when the index bottomed, which I think you'll see that in a typical, more normal 5 to 8% correction. You'll see individual stocks start to be breaking out around this area. But to me, we didn't really see that until we got in here. And then, like a name like Livongo, which I think made a lot of people's years, it did for me, it actually didn't break out, I think, until, not even on this first day where you saw stock, it was a couple of days later. So to me, this was kind of the true wedge pop. And again, and I think you'll see this on a lot of wedge pops that are meaningful. on the lows is you get a big gap. So big gap, big gap. These are signs that the old saying that I have that I learned from one of my mentors is big gap ups equal the street is caught off guard. So there's probably people expecting the market to roll back over here. I actually was one of those people. But then you get this second big gap up, you start to see stocks breaking out. And that's a real sign that people are likely mispositioned and we could start turning back up into an uptrend. So this wedge pop right here, to me, is the first kind of definitive index sign that we could be seeing a bottom. Couple things to highlight. We start to see the vol contract here a little bit, but we've never even tested the 20-day. And to me, you're unlikely to put in a sustainable bottom until you test the 20-day and have at least a couple days to retreat from the 20-day. And then when you can bust back through it, that is the more actionable area where you're going to be able to kind of sustain an up move. I can't think of too many instances where we just blew right back through the 20-day without at least a couple days of pullback and just headed higher. I'm sure we could find examples, but odds are you're going to get some sort of pullback. So this wedge pop to me confirms that this area in here represented the reversal extension. So is what I'm going to...
Before you move on, there were still a couple questions about the exact definition of a wedge pop. So maybe one more time you could kind of go through what you look for in terms of that pattern. And we're going to be going through a lot of examples, both with the QQQ and NVIDIA and Tesla. But yeah, could you give another kind of explanation of what you look for in a wedge pop?
Yeah, so the wedge pop is, you have your reversal extension, and then you trade up to the 20-period moving average. And then when you get that contraction and volatility, and you pop back through the moving averages, and again, it doesn't have to be accompanied by huge volume. Like you can see in this instance, the volume's actually lighter than what we saw in this correction. But it's very positive price action. It's follow through day-esque, if you will. And you should see a lot of patterns set up in individual charts. If you don't see patterns to trade, then this is likely going to fail most times. So I think when you're analyzing the index, that should all be confirmed by what you're seeing in individual charts. But the wedge pop is basically pull up, contraction vol on the 20-day, and then a day where you kind of take out a true pivot. So for me, when I'm looking at this market, I'm looking at this day's high, we go up and we kind of pull back there. Mm-hmm. And prior to any of this happening, I know this is a level of significance, this kind of 194-ish level, or maybe you call it 192.50. But this area here is an area of significance because the market tested it, we pulled back, and that's kind of the pivot that I'm really looking at for the wedge pop. And sure enough, when we took that level out, that's when the market actually started to change its character. And you'll see that as we go through and look at other wedge pops, is that you do get, sort of a pivot. And that's what I'm always trying to do with any setup that I take, is I'm trying to give myself a pivot where if we trade through that pivot, we should continue. Whereas if we fail at that pivot, the stock or the index, whatever you're trading, just the time isn't right yet. And I think that's something that if you read How to Trade in Stocks specifically from Livermore, he talks about, creating a pivot point for yourself. And to me, it's really the area where, hey, if we take this out, we should move higher. And if we fail here and can't take it out, it's not worth owning the stock. And for me, on this bottom, it was right here. And sure enough, when we took it out, we started to see positive follow through.
Perfect. I think that answers it, and maybe we'll cover that as well in the Q&A section. But like I said, we're going to be going through the full example of QQQ. We still haven't finished that. NVIDIA, Tesla, AMBA, and really showing a ton of examples of all the different cycles, including the wedge pop.
Yeah. And then so really, once you get the wedge pop, what's the rule? We got the wedge pop. and we want to ride the 10 and the 20 period moving average higher. So we move up. We're a little extended here, and kind of like I said before, look, if you missed this, one of the worst things you can do in my eyes is flat out chase. So you should be trading individual stocks here, because that's really where you're going to get an edge. But you kind of get up to here, in my opinion, in any of these days through here, at some point you're going to get a pullback in the index. You don't know when. Maybe you go up higher here and then pull back, but at some point you're likely going to get that pullback. And sure enough, that's what happens. We pull back, and when I see a bar like this, I'm mentally thinking we're probably going to have like another bar. But we snap back, and this ends up being the crossback. We move up. This, to me, like a 1 to 2 day pullback like this is more just EMA support. It's not really a pattern. This you could consider more of a basin break, but it is sort of just like EMA support again. But it is a bull flag. So we work higher here, and if I'm mentally trading this as a stock, as we make the wedge pop, my stop would be right here. We kind of build a new consolidation here. I would move my stop up to this area, go up, pull back. When we reconfirm up here, my mental stop would be right here. So even though I'm not trading the index, I'm always paying attention to it, and I'm kind of moving my stop up on, my mental trade of the index. So like when we're right here, I'm thinking, okay, the index shouldn't lose this area if it's healthy. We go up, we pull back, and when we reconfirm right here, I'm thinking, okay, the index should hold this area on a pullback, and I continue that the whole way higher. So like when we pull back and break out of this pattern and do what I call reconfirming price strength confirmation, I'm looking at this new low, and really is all you're seeing is higher highs and higher lows, right? So if you were to read Brian Shannon's book, I mean, literally this is all we're seeing, and we're riding this 20 period moving average higher, and we're assessing the price action. When we take out this high, stops here. And to me, this is the first real, clear basin break that's, more than like a week long in here. Where do we find support? Right on the 20 period moving average. And when we head higher, your kind of mental stop in the index should be here. To me, this is like the first extension, just sort of like an area to take note. You can see that we get 238. We get about 4% above the index, or above the 10-day on the index. And I find on the index kind of that 4 to 5% area is where the index has trouble, not necessarily pulling back like we saw here, but you're likely going to get some sort of consolidation through time, just to let the 10-day catch up. In this instance, we do have a gap down, and bigger volume, which is definitely something you want to take note of. I think that we weren't extended from the 10-week here, or this is more like the first extension, so you can likely expect support to hold. One thing I will say though is this extension here, when I was trading the market, I was expecting us to fall into more of a correction, because on the weekly we actually got extended, and this was a basin break. To me, this was a second basin break in here. And I was sort of thinking, okay, we've had 2 basin breaks, and at the highs here, we're about 5% from the 10-day for the second time. I was actually lighting up and thinking, this is going to lead to more of a correction. I think COVID was pretty unique in that we just continued to head higher. But the rules held in that if your stop was here when you kind of took this out, when you took out this high again, your stop was here, and you traded up. So even if you were, more aggressive in taking profits here, which based on everything I've discussed, and based if you looked at the weekly, you would be, the rules still started to hold until right here, when we took out this low. The caveat is that we closed above it. So there was never really truly a sell signal. One of the things that if you read William O'Neill, he talks about when you lose the 50-period moving average and retake it, it can be a sign to put your position back on. That's actually kind of how this was for me in the market. I had kind of thought that we were going to fall into a correction here because it was the second extension. It was the first extension from the weekly. And I thought we were probably going to head higher, but that we were going to have kind of a multi-week consolidation. But when we took out this low and retook the 20-day, I think especially when you trade back above here, is what you're seeing is sort of like a double bottom base take place with this as the new long entry. And we start to work up. So to me, this was almost kind of like a new wedge pop, even though it's a basin break in the grander scheme of things. We go up, we reconfirm new highs here, we pull back into the 20-day. When we take this area out again, this should be your new stop level here. Similar here, when you take this out again, this should kind of be your stop level in the index. And then one thing you're starting to see here is a major acceleration in price. And if you go look at the weekly now, to me, as I said before, I thought this was the second extension, and this was definitely the second extension. So I expected us to go through more of a consolidation here. But definitely on the weekly, we're getting extended here. Like on the highs from the 10-week on this extension versus the 10-week, you're almost like 9% above the 10-week moving average. And kind of like I said before, my mental threshold is 7 or 8. So I was thinking we were going to go into more of a correction here. But then when you get even higher here, I mean, we're 10% above the 10-week. And if you look at the daily chart, you can see we're really starting to accelerate. And this is a clear sign of a clear exhaustion extension to me. I think on Twitter at the time, I even said you want to be real careful, with this ramp. And this is what we call a spinning top candle, or sorry, a hanging man candle. If you read Steve Nissen's book, it's a sign of potential, trend change, and that this down move is actually marked by people taking profits. And then there's, people buying late who are putting it back up. But if this fails, which it does fail here, and you'll see that it's marked by a downside wick again, you'll see this type of downside wick action a lot at tops. The market has potential to unwind. So we get a big gap down here, and we take out this hanging man high, and you start to see the massive volume come in again. But I think you could anticipate this very easily by understanding where the weekly is. And then when you're just playing with fire here when you're getting 9-10% above the 10-week, and you're also getting extended from the you're 4 or 5%. You're kind of hitting the daily threshold versus the 10 EMA, and you're also hitting that week. You're beyond the weekly 7 or 8% number, and this is really to me like the third or fourth extension in this move. It was obviously a pretty unique move, and it's not a surprise that we kind of unwound the way we did based on where we were on the weekly. So if we go back and look, wedge pop, cross back, and we're just holding higher highs and higher lows. To me, basin break. And I think to me in a normal environment, you would probably start to see more of a correction here. I think because we had such a dramatic, 20 to 30% correction, that this was able to extend more. But I think typically in a 5 to 8% correction type market, this second extension is something that is going to lead to more basing than what we saw here. But nonetheless, very extended on the weekly, and you start to see this acceleration. This is a sign of euphoria, and sure enough, when that euphoria pops, you start to get that unwind, and you fall into a correction on the daily chart. So any questions kind of on this move right here?
Yeah, I'm not seeing too many come in, but there was a question about the book you mentioned, looking at the candlestick chart patterns.
Yeah, so hold on. So I think if you want to learn more about candlesticks, there's really only one book you need, and it's a Japanese candlestick. It's not Japanese candlestick charting techniques. It's a big yellow book, and it's written by a guy by the name of Steve Nissen. So that's Steve Steve Nissen Nison. This is, to me, it's the holy grail for Japanese candlestick patterns. So highly recommend picking this up. And I think you can learn a lot from it.
Yeah, absolutely. And we'll have that list of books that you talked about. And going back to this example, I think what's really key is how you considered how extended you are on not just the daily, but also the weekly, and taking everything in context. And I think we'll really see that when we go through the full example of Tesla, and how you kind of understood how far it's come and how it might need a much longer base because of how extended it got on all the different time frames.
Right. Yeah, 100%. So you don't want to just get caught looking strictly at the daily chart, because you won't see the whole picture. Whereas when you see this weekly, you can really start. I mean, even if you go look at us and our acceleration from the 10-week, even from down here, it's pretty routine, right? We're kind of just stair stepping higher, the 10 weeks below us. And then right here, we accelerate a little more. And even this pullback here, we really don't close the gap to the 10-week down to like this level. Then we start to accelerate even more. I mean, this is euphoria, and I think you can see it somewhat clearly on the weekly. And then that's going to allow you to truly see it on the daily. Because there were a lot of people. I know Mark Minervini was talking about this for sure at the time. And it's because you just start to see this rampant acceleration. It's just something you want to be careful. And then when you get confirmation here, you rather than wait for like the moving averages to break, most tops are gonna have this exhaustion. We saw it into COVID, right? Where you really topped well above the moving averages. I mean, we were well above the moving averages, and we're well above the moving averages here. And if you're going to be waiting for like this break, I mean, your stocks could really crater in that one day. So seeing the weekly, understanding where we are in the big picture, is going to allow you to execute on your actual trading time frame much better. And this is a great example of like using the cycle and understanding where we are. So you got the wedge pop, you got the crossback, basin break. So like, oh, we've got two basin breaks, right? And kind of what I said earlier is, once you get that second basin break, sure, can you have a third? Absolutely. Like there's no like hard set rules as to what's going to happen, but you should definitely not be getting excited about an acceleration after you've had your second basin break, because you're near the end of the cycle and you should start be thinking, okay, this is kind of getting crazy. This is getting to an unsustainable level. And I want to, start to get a little bit more conservative. And the thing is, guys, it's not easy, because let me tell you, every single person on Twitter, there are definitely people that aren't, but most people are really, talking about how much money they're making and, how great they are at trading stocks and stuff. And you can actually recognize that sentiment and that euphoria and use that to your advantage. So see the weekly, and just kind of understand when you get accelerations like this, you better be careful.
Absolutely. And this isn't entirely related, and this is actually kind of a step away from this example, but um, just in general, the stocks you're focusing on are usually in uptrends above a rising 50-day and 200-day. Somebody was asking whether BABA recently had a wedge pop, basically. So maybe you could touch on this recently. This probably is an example. This probably isn't a stock you're super focused on because it's in this longer term downtrend. Is that right?
Yeah. So I haven't looked at BABA in quite a while. I don't trade China stocks, and kind of the exceptions to that are if I think it's a company like BABA or Baidu, I might trade. And what's interesting is I haven't pulled this up in a while, and you can see that most of my chart analysis is gone, kind of past here. And there's a reason for that. We kind of lose this 50-day, and the stock just, I guess this is maybe a reversal extension, maybe a wedge pop, but it's just like, the 50 days in a downtrend, the 200-day at this point here is rolled over. And it's just like there's so many better opportunities that you could be trading. I mean, think about all the opportunities there's been this year where this stock has just, really it's been in a downtrend. I mean, especially once we lost this area right here. I mean, this is actually, if you look at it, it's a upside down cup and handle, and it's a major pattern to me. This is kind of a back test of it, and then this is like a base and break. This is a base and break. So the only positive I see in BABA, which is I really don't see any positives. The only positive is that maybe this was a reversal extension. Maybe. But I think this stock's in a void personally. I'm not interested in it.
Yeah, I didn't want to go too in depth in here, but basically, in a stock in an overall downtrend, the down cycle is going to be stronger than the up cycle in terms of price. So you want to be focused on stocks near all-time highs and stocks showing relative strength. And we'll cover this way more in depth and in building a focus list and the setups as well, I imagine.
Yeah. So just like for me, like if I were looking at this stock, like really like the big pivot I'd be watching is like here. I mean, you could maybe try to make something here, but you're below these moving averages. So I would want to see some, more basing type action down here and get the 50-day to flatten out more, and then maybe look to get long. But again, I think you're trading a laggard stock. So, for me, I am a small time player in the grander scheme of the market. There's institutions like Fidelity, T. Rowe Price that are moving stocks around, and I can be fully invested with like 8 to 10 stocks, maybe stretch that to, 13 to 15. But is this one of the top 15 stocks in the market? And, I would be inclined to say no.
Perfect. We'll leave it at that and revisit the concept later on in the webinars. Awesome.
Okay. So let's look in here. So I think that this is actually one of the better exhaustion extension examples you're ever going to find, because I think it was pretty obvious. And you're going to get a big gap here. This is like a breakaway gap, reverse downside wick. To me, and this doesn't fit the rules perfectly, but I think it's like within context of the weekly and the volume you're seeing here. This is like your wedge drop. And then things happen very quickly to the downside when you're in a bull trend. And that's exactly what happens here. We trade up, you get the cross back. To me, this is kind of your base and break right here. So it's like a couple days, it's like nothing. And then is what you do. You don't even really get an exhaustion extension to the downside here. And that's okay. Every step doesn't need to be played out. To me, this was the wedge pop, and that you create a pivot right here. I think that's clear. And I actually made a big mistake in 2020 in that I thought we had a wedge pop here, a cross back, we reconfirmed. And I remember the names I was on Roku, I was on Beyond Meat, and they all looked really great. And I actually thought right here we were going to build a basin break, and we were going to break out and head higher. Now, the mistake that I made, and this goes back to the weekly again, is that you can expect the daily chart to base out and head higher if you're coming off the first extension from the 10-week. But when you're coming off the second extension from the 10-week, very similarly to when you get the second extension on the daily, the weekly is going to need more time to base out. And that's exactly what we saw happen. And I'll show you the exact mistake I made. Second extension on the weekly, and we needed more basing before we were going to be able to hold a sustainable move higher. And the weekly is going to trump the daily. So the mistake I made is I was basically looking at the daily, and I did not take any profits on the stocks I was holding in here. And then is what I ended up having to do is I got stopped out of all of them. And it is what it is. I misanalyzed where we were on the weekly. And I was thinking that we were going to turn right into a daily upcycle, and we started to, but the weekly wasn't ready. So we had the cross back, and we tried to put in a basin break here. But as what ended up happening here is we put in what I call a too tight for too long pattern. This descending channel ended up building out right here. I actually had a wedge drop where we broke through the moving average here. And at this point, I was out of all my stocks. Even though we tried to hold in here, it was just too tight for too long. Every single person was watching this pattern, and we weren't breaking out of it. That's kind of a red flag. And if you think about where we were in context from an event perspective, the election was coming up, and the market, there was just too much uncertainty, for the market to punch higher. So, if you were, I've been stopped out of everything here, but I was still looking, can we bust back above here? And if we could, I had names I was watching, but we couldn't do it. And we headed lower. This was, definitely the true wedge drop, but really this is all just kind of chop on the weekly. The weekly was basing out the second extension, third extension from the weekly. And you have to recognize that. And that's something that I'm personally trying to get a lot better at, is recognizing like a market that is in chop. And that's a lot easier to see if you're using the weekly chart than if you're just using the daily. So what ends up happening here is we build out and we put in a wedge pop right here on the daily. And again, marked by a big gap up. So I think one of the things that I think is a mistake that a lot of people fall into the trap of is thinking that all gaps fill. When in reality, most trends, in my experience, actually start with a big gap. So we get a wedge pop here, but I think there's still uncertainty with the election. But so that creates a little more volatility. We had news on the vaccine here, like the vaccine was announced, I think right here, kind of hit some stocks. But we actually follow the cycle perfectly, and that we pop, we have the cross back here, we hold. And then this is kind of where the market got easier. And on the weekly base here, this is really where volatility contracts. Whereas this was kind of a unique bottoming pattern in that we got a wedge pop, but the volatility was still kind of off the charts, which made it, difficult to trade. Like I actually got pretty long a lot of stocks here and got stopped out of a lot of them, right after. And then when we start to see volatility contract, that is when the market actually shows its more sustainable move. So this was unique in that the wedge pop actually didn't offer the best buy areas. And, not every cycle is going to be the exact same. So paying attention to that volatility contraction is always going to be key, because kind of once we break out of this bull flag is when things start to get easier.
And Oliver, let me jump in with a question here. Could you go to a weekly chart and look at this correction? Because there's a question, a really good one from Randall. How did you know the weekly chart wasn't quite ready yet and that we were still going through this pretty choppy pattern?
Well, so I made the mistake in not knowing. So at the time, I didn't handle this correctly. But in going back and studying it more, this was really, to me, this top was actually the third extension on the index. So this was the second extension. This was the third extension on the weekly. Mm-hmm. So the same way that on the daily, when you get the second extension, you're usually going to need to base. On the weekly, when you get a second extension, and definitely when you get a third extension, me going forward, I'm going to expect the daily time period to be choppier because the weekly needs to rebase. So to answer your question, I didn't know at the time because I just made a mistake. I mean, I misanalyzed the market. But I guess that's a good point too. You can still have a good year and do really well if you make mistakes. I mean, nobody's going to be perfect. But in retrospect, moving forward, when I see these second, third extensions on the weekly time period, I'm going to expect, probably at least 6 to 8 weeks of more choppier action. And that's exactly what we got. And then when we saw this, contraction here is where the market got easier. And I don't think it's any mistake that, the election was on the 20th or so. And then that's when things got easier. So, this was sort of a unique period here because of that.
And one more thing that I think would be interesting to talk about is I know when we've done the mock run throughs, a lot of these wedge pops seem to happen after a stock has formed these like descending channel lines, right? Is that correct?
Yeah, you'll see that a lot. And I think they're smoother on individual stocks than on
Yeah,
the actual index. So I think when we go look at individual stocks,
perfect.
you'll really see that. But yeah, so I'm going to try to actually get through this because
Yeah,
I
go for
know
it.
that people do want to look at individuals. So basically we break out and it's that same action, right? Once we kind of get going, we break out higher highs and higher lows. When we take out this high, the stop, your mental stop on the index, because I don't trade the indexes here, we go up, we pull back, put in a bull flag. And when we take out this high, my mental stops here. And I follow that up. And you'll see that these higher lows and higher highs, they play out this whole way up. Like this is what a trend looks like. And do not try to pick the top in a trend, in my opinion. Try to use the tools like the extensions to help you. But at the end of the day, the first real sign that this trend had a potential weakness to me was kind of right here when we lose the 20-day. And this to me was a wedge pop or wedge drop. We had a basin break. We had a second basin break in here. This was really only the first extension. So I wouldn't expect to have a wedge drop, but we did, and it proved to be a shakeout, which, again, like nothing's perfect, and we end up coming back. And to me, this ends up being a bull flag. And, for a guy like me, when we get a wedge drop, I might get stopped out of my positions. And if we reverse, that's just how it goes. And you take your entries back long. But this wedge drop here, because we kind of I wouldn't even really consider this a second extension, but more a lack of momentum. And this is another way I think you'll see markets top is you'll get just tight bars and a lack of overall momentum, and things stop moving. And then you'll lose this pivot, and that's the wedge drop. So I think a year like last year, where you're getting more euphoria, you're getting more of those exhaustion extensions. And then I think multiple times this year, you'll see this kind of stalling, slow action followed by the wedge drop. And I think it just is representative of a change in the environment. But basically, once you get that wedge drop, it's pretty clear. Again, we're seeing the wedge drop marked by a gap down, right? So we get the drop, we get the cross back. To me, kind of this here is the basin break. And then you don't know this is a reversal extension until after the fact, but it ends up being, you trade up to the 20-day. This is a perfect example of why I try to tell people, like, it's not just a trade back through the 20 EMA, because we've traded up, but there's been like no contraction in vol or anything. And there were really no stock setups here at all. But then we kind of base out here and we build a true, this actually ends up being an inverted head and shoulders, kind of a descending channel. And it's a fairly, predictable buy area. And actually, if you go back and look at examples, there were names like NVIDIA and things like that set up here and had really nice runs. Whereas the index here went on like a 2 to 3 week run or so. But there were some stocks that went on and made really nice moves during this period. So just identifying, this is the wedge pop. So here's kind of your extension, or sorry, we're over here. So here's the wedge pop marked by the gap. The unique thing here is you don't really get a crossback. This is kind of where my system has struggled a little more this year, and that the moves haven't been as extended. So I was thinking right here, we're going to consolidate into the moving averages, head higher. That's my thought process. That's what I'm thinking, but everything doesn't pan out the way you want. And kind of when you lose here, you get the wedge drop, and it's really just a sign that, this trend isn't going to extend. And unfortunately for me, in environments like this, I'm not the kind of guy who's really taking my profits into this. I'm getting stopped out on things and roll back over, get the cross back, basin break. Here's your extension. You don't know that till after the fact. Like right here, I'm actually thinking we're going to roll back over. You get this bullish counter attack, and that's kind of like the, let me pay attention. Maybe this was the extension. And this to me is a pretty clear pivot. Here's a wedge pop, and there were a ton of stocks set up here, which I'll show you. And then this is where you actually get that sustainable up move. So in moves like this, usually is what happens to me, at least, is I have nice gains and I'm kind of raising my stops and I'm expecting us to continue to follow through. And then I end up getting stopped out of my positions, and I'm not maximizing my profits. But that's just how it goes. I mean, when we get an extended trend, I'm going to do really, 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 really well. And when we don't, I'm going to get stopped out of things. But likely I'm going to get stopped out of things for sort of smaller gains versus actual losses. So that's just kind of how it goes.
Oliver, can I jump in with a question?
Yeah.
Yeah, so Amelia was asking, just looking at the year 2020 and 2021, a lot of the correction seems to kind of take the same amount of time. Is that something you kind of mentally take into account, or you're just following the price action? You're not really looking at the amount of time we've been in a correction.
So is what I would say to that is I'm more looking at like the weekly. And if we're coming off like a second or third extension on the weekly, I think you should expect a longer correction. Now, does that mean that you need a massive sell off like we saw in the COVID correction? No, but you're likely going to, take more time to kind of base out, versus when you're at like a first extension on the weekly. I'm more expecting corrections to hold at, kind of that 6 to 8% range. But I am always watching the cycle. Like that's what is causing me to get in or out. Now, I think the one thing that I can do to improve is, if I'm more understanding of, we talked about this environment where we had like a third extension on the weekly, maybe even though we get a wedge pop here, I play the sell some, hold some game because I know where we're at on the weekly, and maybe this move isn't going to hold. But one of the things that I'm just kind of content with is not every environment is 100% optimal for my strategy. And maybe I'll make less in these choppy type of environments, but trust me when I say, like, in good environments, like, I'll really, really clean up. So if I can, make a living during these kind of choppier markets, and maybe I'm, not maybe the guy who takes profits more quickly than me is going to do better. I'm okay with that, because I know, when we get this trend, like I'm gonna do really, 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 really well. And I'm hoping that's what's about to happen here in the year end, but we'll see. But yeah, so I'm trusting the cycle. Sorry, that was a long-winded answer to your question.
Yeah, no problem. Do you want to jump ahead to the current price action and kind of what you're watching now, and then we'll kind of move on to the individual stock names?
Yeah, exactly. So I think you can kind of see this move. It follows a lot of the other moves. This current correction, very similarly, notice how we're just stalling tight price bars. This is what I consider too tight for too long. It's something to pay attention to when you get these types of consolidations that just everybody's watching. It's sort of a sign, the market just doesn't have the power to head higher. So kind of is what we saw. I actually think the wedge drop here was up here, kind of because of the stallish. But either way, this is definitely the wedge drop here. But we come down. Whether you consider this the basin break or the crossback, to me, it's really kind of irrelevant. We find resistance at the moving average. We roll back over, little short consolidation here, and then we come down. I was personally thinking we were going to put in one more bar down here. So I kind of missed some of the best moves off the lows here. But either or, this was the reversal extension. We definitely started seeing some individual stocks set up and hold support and break out literally right here, which I can show some of that. But we come up, we resist at the 20 EMA here. And to me, this is kind of the pivot on the market here. And we notice how we come down and this whole area in here, we're consolidating out this volatility, and you're seeing patterns build all throughout here in the market. And then this is the wedge pop. And my current thought process on the market here is, and I mean, if you followed me on Twitter, I pretty much was looking for the wedge pop all through in here, mainly because we saw individual stocks start to work, right? So even though I didn't get the lows here, unfortunately, I missed names like Net and things like that. But other names started to follow through, started having positive price action. And to me, by the time you get this wedge pop, you should sort of be positioned already. And at this point in time, to me on the market, I'm not sure whether we do something like this. Do we kind of follow through higher and then pull back? Or are we maybe going to do some consolidation in here and, build that early cross back and then head higher? I'm not really sure, but mentally I'm thinking the upcycle has started. We had our wedge pop. And I'm looking to, hold some of the positions that I'm in and give them more room to consolidate. Whereas, in this area, I wouldn't be thinking that way because I wouldn't be sure. And look, I'm still not sure now. We could roll right back over. Nobody knows. But we had a wedge pop. And so I'm thinking that the next thing that's going to come here is an EMA crossback, whether we go up and then pull back, or if we pull back here, I have no idea. If I'm kind of looking just at supply and demand here on the chart, right through here, this level, I think something that would make sense, and rarely do things pan out exactly how we think, right? I think something like this would make a lot of sense where, we start to turn these moving averages, we'll get the 10-day above the 20, and, maybe something like this plays out. And then we start to take at this level. That's when you could really get like a, real, sustainable uptrend where you really start to see the higher lows and higher highs. So what we've got here is we came up, we made a higher low for the first time, right? And now we've made a higher high. So really the wedge pop, if you think about it, it's the first time we've shown a change in higher lows and higher lows and higher highs. And now I have no idea where this is going to stop and pull back. But understanding how trend works, at some point it is going to pull back. And is what we would want to look for is another higher low here, to me, as the next area where you could potentially look to get long stocks, or, add to names. And I'm not saying that if you buy something here, it's going to fail. It's just, to me, the lower risk entry was in this area. And now I mentally am kind of in wait and see mode. I'm comfortable letting my names trade. And I'm waiting for that next potential higher low to either add to things or maybe pick up a new name. So I'm looking for relative strength. I'm looking at a name like Net that I missed. And, maybe it can put in a consolidation here and I can wait and get an opportunity to get long it. That's kind of my mental thought process here.
So just to kind of recap, before the wedge pop, you're kind of watching that, and basically in anticipation, you're watching the individual stocks setting up and trying to play those before the overall index makes that wedge pop. Is that right?
Yeah. So I think down here on the reversal extension is actually when you saw some of these first movers move. So if you were to look at a name like AEHR, which I know a lot of people are on, look at where it pulled back into the 20-day, right?
Right.
So this stock is actually in a strong upcycle here. We really broke out here. We put in a base and break. We broke up. And this is like a buy area, and it's no mistake that it hits the 20 period moving average on 10-4 the same day that the index bottoms. That's not a mistake. So, you see your strongest names kind of get going when the index is bottoming. And then what is this 10-7? You could say when this thing really broke out, it had like a wick play. 10-7 happens to, I guess, just it's really like between this area in here, like this whole area right in here. This, I'll call it this 6 to 7 day period is kind of when you can get stocks moving. And then, you can definitely be buying names on this day. So, I can just tell you for me, right now I'm long AMD and NVIDIA, and, I got this on this day, which married up with the index. Same with NVIDIA. And, it's, but, I don't want to be buying this right here, right? Like, I think the buy area was like here and here. At this point, you want to be patient and wait. Now, could this blow through this trend line and keep going? I mean, absolutely. And unfortunately, nobody knows. Like, if we all knew, we'd all be, mega millionaires, right? But mentally, that's just kind of how I am. Is I like to wait, and so, like, if this were to bust through, even if it did, maybe it would pull back and test this, and that would line up with the cross back on the moving average, and you could look to get long it. But I think you want to try to wait for those optimal areas to execute. So that's just for me, that's kind of my thought process right here.
Perfect. Oliver, do you want to take a quick sip of water at least, or even we've been going for an hour, so do you want to take another 5 minute break before moving on to Tesla and Nvidia, or you're good to keep going?
I'm good to go. It's up to you guys. Just let me know.
Okay. I haven't seen many requests for a break, so I think we'll at least try to get through Tesla at first. And this, I think, putting things into perspective, going through the individual names, that's where everything really starts to click. So if you're still a little bit confused, yeah, this is where everything should come together. And if you do need a break, feel free to go ahead, take it on an individual basis. Like we've said before, this is 100% recorded and it'll be archived for you to watch over and over again, so you won't miss anything by taking a break. I know we're throwing a lot of information at you, and Oliver, I think you're doing a fantastic job going through these charts and answering questions at the same time. So at your leisure, let's get on with Tesla.
Okay, so let's look at Tesla, and I'm not going to go through this whole move here, but I think anybody paying attention to Tesla at the time, a lot of people were talking about this as a blow off top, like for good, right? And I think it shows the signs. We march higher, we go through all the different steps, we get ridiculously extended, at the top here, 193 versus 130. You're like 40% extended from the 10-day. Massive volume. This to me is a blow off top. And then it's confirmed right here. We kind of come down like a lot of wedge pops set up, and we actually support on the moving averages. But then at some point, the buyers can't support the stock, and you're definitely triggering your wedge pop right here, or wedge drop right here. So if you didn't sell this is kind of confirmation. Shoot, I wish I sold that, but I've, now I've got to get out. And sure enough, we come down, we hold the 50-day, we trade up, and this is what I call a gap and trap. So you want to be very careful, especially in downtrends, of chasing gap ups, because they often get slammed, and that's exactly what happens here. So to me, this is the cross back. We lose this. This is kind of the base and break to the downside. And then is what happens here coming into the COVID lows is we sell off. Like to me, even right here, this is a potential extension, but then we break lower the next day. And this is getting ridiculous. You're getting very extended from the 10 EMA. But there is a target support area if you were to look at the Tesla weekly. And it's not it's really, at the time, I actually played this on a shorter time frame long. I didn't play the reversal extension to hold, But we came right into this weekly support level. And also on the daily chart, it was right into the 200 period moving average. And sure enough, that's where the reversal extension took place on Tesla. And you'll see this in tons of names. If you go back and see where they bottomed, it was like right into the respective support level. It happened to be pretty clean on Tesla. But what happens? We snap back to the 20-day. Volatility is still crazy here. If you picked the low and, great work, but this was probably tough for a lot of people to hold through. There was crazy moves intraday. And to me is where this stock got real interesting, was right in this area. So huge volatility, test the 20 EMA, contraction and volatility. And sure enough, whether you considered this the wedge pop or this the wedge pop, I think this was obviously the easier one to identify. We'll call it here. This is kind of your wedge pop, because even though we trade through the 20 EMA here, there's no real pivot. And kind of one of the things that I always like to do is trade against a price pivot where I can know if I'm right or wrong. So we bust through this pivot, and this is definitely, the wedge pop where we're moving into an uptrend, and then we start playing out the cycle. So as what happens, we move up, we pull back, find support on the EMA. They did shake this out on earnings. So this was a big gap up on earnings, but we continue to hold higher lows and higher highs. We hold the 20 EMA. And as what happens is we build what I would consider to be the first basin break. So cross back, then this is a basin break. And notice how I said earlier, coming off like a major correction, the first basin break is usually going to line up with a more traditional pattern. And if you look at Tesla, we have a big cup, and this is a handle. And this is kind of the first traditional buy point. So the way I view it is with my strategy, you're already involved. And this could be an ad area or an opportunity to really kind of size up your position. Because if you think about it, the trigger here is like, 167, your stop is in this area, like 160 or so, that's like 4%. And the nice thing is, what do we see here? We see this subtle gap up, right? So pay attention to the gap. I cannot emphasize enough that like the strongest stocks will leave little unfilled gaps. Sometimes they're very subtle, maybe like maybe it comes down and like goes right there and doesn't close it. But those unfilled gaps are like subtle signs like, ooh, somebody didn't want to wait for the gap to fill. They stepped in and supported it higher. And it's just a little sign that you're onto a good stock. And then what do we see here? We go up, we build a little bull flag here. This could be an opportunity to add again to your position and raise your stops, or just let it trade and raise your stops. So I call this reconfirming price strength confirmation. So we go out, we pull back, and when we take out this high right here, it's a sign that we've made a higher high. I can raise my stops to below this area. And then we do it again, right? We build a second basin break here. And we move higher. So the unique thing for Tesla here is this is the first extension. So I would actually not be looking to take profits here, and I didn't. I did in here consider this to be a wedge drop, and this was truly confirmation of that wedge drop. So this was a tough one for me personally, in that I thought I had a great area and I was actually shaken out. But then is what happened is we got a wedge pop here and you got back long the stock. So that's the downside of using the 10 and the 20 period moving average versus something like the 50-day. And I know a lot of people say coming right off the bottom to use a longer period moving average like the 50-day. That's not what I do, but maybe it's something I should consider. But either or, back long here on this wedge pop through this pivot here at 307.25. I would say your max pain stop would be the day's low, which is a pretty, significant stop. So that's kind of the advantage of being able to trade stocks intraday is, maybe you can have a tighter stop. But either or, we go up. Then when we take out this area, this is what I call an ignite bar. So when you get like a long range bar, those bars are significant to me, especially if they're on volume, which this one was. So you want to raise your stop to below that area, go up, consolidate, You sort of get another ignite bar here. So when I get ignite bars where like I have a nice profit cushion, I may not put my stop, right here. I may kind of keep it a little lower just because, I don't want to get shaken out. Go up, pull back, reconfirm price strength confirmation, moving your stop up to here. Now, this instance in Tesla, I thought was a lot easier to sell because it was the second extension on the weekly. So this was a tough one for me. This one was a little more clear. If you look at the weekly chart on Tesla here, so breakout, first extension, second extension. I think it's much easier to sell because you have the second extension on the weekly, and then you can also expect a longer period basing pattern, which is exactly what we got. So this is the second extension. This is kind of like your exhaustion extension. And then is what ends up happening is you have a wedge drop here, but this whole cycle doesn't really play out. This ends up actually being a wedge pop again. But I think it was more easily avoided because you had the second extension on the weekly. I did do a better job handling this actually than, what I did with the Qs. Because second extension on the weekly, what can we expect? We can expect more of a multi-week consolidation, and that's what happens. So to me, the first time to get back long Tesla here, and I took this trade, was in this area, right here when we broke out, and unfortunately stopped out. You get a wedge drop here, and the stock just wasn't ready yet, and that's how it goes. Like I'm only right on like 30 to 35% of my trades. So the key is to have, rules in place to handle this. So we broke out, we lose this low here, I'm stopped out, and it's a wedge drop. And really there's no actual signal really to get long this thing until right here. We have a big gap up right here that goes unfilled. And one thing that I think is very important is this gap up happened on a catalyst. So that's always more important than just like a gap up. If there's no catalyst, this might have faded back down. But we gapped up on inclusion in the S&P, and then notice the price pivot that we have here. So we have a price pivot around 465, 464. And when we take that out, to me, that's your buy signal. This is really confirmation of the wedge pop. You could put a stop at the low here, or if you're trading at intraday, you can have your stop on an intraday chart. We go up, we pull back, we reconfirm price strength confirmation. Similarly here, I'm not keeping my stop right here because it's just too close, like with how extended we are from the 10-day. I'm probably moving it to break even here, just to protect. But you want to give the stock move to work when it's early in the cycle, whereas later in the cycle, you want to really tighten your stops a lot more. But what happens, we go up, we pull back, we go up, we have our first basin break here. This was, false breakout. A lot of people shook out on this. I was on the shares I added here. But then we kind of put in a bull flag and you can rebuy. We go up, we pull back, we reconfirm price strength confirmation here. And then we just continue out the cycle. So one thing about this top here, that again, I thought made it easier to identify, and you're rarely going to see this, but we had a second extension on the monthly chart. So this is the second extension. I think you're rarely going to see too many second extensions on the monthly, but definitely something to pay attention to. If you go back, and I think I did an interview with Richard right around this time, and I basically said, I think this was the exhaustion extension. I don't know what's going to happen here, but I think this stock's likely going to chop around for a good period of time. And the reason I felt that way is because we were so extended on the monthly and the weekly. And sure enough, this move higher failed. We end up having a wedge drop here. And this led to a pretty significant correction. And in reality, it's still, I do think, obviously we're kind of coming up and coming potentially out of this basing pattern, but there's a reason why we've been basing here for about a year. And it's because of how extended we got on the monthly from the 10-month moving average. So right now in Tesla, if you were to go look at Tesla, we put in an extension here, but we could never trigger the wedge pop. We put in a second extension to the downside here, which you don't see too many second extensions in a healthy market. And I think that was just because we got so extended. Like, look how far above the 200 period moving average we are. That's not something that I really use, but it's pretty crazy. Now, the first buy trigger we had here was this wedge pop. So I took this trade. We had a wedge pop here, then this was a crossback. I thought this was a great setup because, you know, you were able to get in this with such tight risk. And I had this trade on, and unfortunately it didn't work. And we got stopped out here on this wedge drop. We didn't get follow through. We didn't get a basin break. I was thinking this was going to be a basin break. And if we had been able to work higher here, you know, you could have raised your stops to this area and kept riding the trend. Unfortunately, it didn't work. And so what happened, you made a little on this buy area. You pretty much, you know, broke even on this, you know, maybe made a little. But that's how it goes. And the nice thing is that you were able to avoid this next down cycle. So wedge drop, cross back, basin break, and then not shockingly, you get the extension right around this 200 period moving average. And what happens, we build out this contraction vol, and the next buy area is right here. I have not really been trading Tesla as much because it's been so choppy. It hasn't been good for my style. There's been better opportunities. Now I think we could potentially see that changing with kind of the way we held the 20-day in here and held the 10-day in here and got out. Unfortunately, I missed this trade just because Tesla hasn't been the best stock for my style, because it got so extended. Now, what would make that change for me? I think if we kind of came up here and built out, you know, a bigger weekly basing pattern, you know, Tesla could really come back into play as, you know, key focus stock for me, once again. But that's how the cycle kind of played out the last couple of years in Tesla. I think you can kind of see how if you stack the weekly with the daily, and in some instances the monthly, you know, how it can really help you in your decision-making process.
Perfect. And we'll open it up for any questions that people have about Tesla specifically. I think the key takeaway that a bunch of people noticed was look at those different timeframes, weekly, monthly, look at those extensions and take everything in context and recognize when the stock might need a longer period to consolidate. So no, that was awesome. And we'll see if there's any questions on Tesla, but if not, we can either take a break or jump right into NVIDIA.
Yeah, I'm ready to keep going.
Okay. I don't see any questions coming in. I've been answering a bunch as we go through it. So, yeah, let's just jump in with NVIDIA and cover the 2021 action.
Yeah. And so like just one thing that I'll say here is like Tesla was my go-to stock in 2020. Like I did really well in Tesla, Livongo too, actually, but Tesla throughout the whole year. And, you know, it hasn't worked as well this year, but I think the key is to still follow the signals. Like it didn't work here, but like the signals kept you from getting smoked, right? You could have said, oh no, Tesla's like going to rip back to highs. Like that's what I was thinking. I was thinking that for sure. And, you know, it didn't work, but you can avoid just getting absolutely smoked by listening to the signals. So that's just, you know, one thing I would say is you got to have the humility to, you know, just say, darn, that's frustrating. But, you know, the signal says this is the move. And you know, that's just one thing you got to do. And, you know, that's trading.
It's about taking losses really, really well and just moving on to the next opportunity. Yeah.
Exactly. So look, I'm not going to go through NVIDIA all last year, because, you know, I actually think that'd be a great thing for everybody to do is go look at NVIDIA And I'll point out some key things here. 200 moving average support, right? And we build out this base and we start this trend. I think this is an obvious exhaustion extension. And I think if you look at the weekly, this longer basing period was somewhat predictable, but maybe go through and, kind of mark up what you see here, and, where you think you might've got long. But it's what I'll do is I'll kind of start in 2021 with NVIDIA, just for the sake of time. This has been a key stock for me this year. I actually didn't play this in here, just because it wasn't on my radar yet. Don't ask me why. But I always, when I go look at stocks, I always try to be totally honest with myself. Where would I have bought NVIDIA? And I think I would have bought it right here. I think this would have been a wedge pop. I think I would have been stopped out right here. And then I think I probably would have tried it again right here. And I think I would have been stopped out here. But then I think this area you could have bought and it would have started to work. And then you probably would have been stopped out in this range, and definitely in this range. And the reason that I show that is because, as Richard just kind of said, it's important to be able to take losses, right? Like this would have probably been a scratch. This would have actually been a tiny winner. This would have, like, you would have, I would have thought again, like, okay, we're going to get the base and break and head higher, and it didn't work, and you would have made a little. And the reason I show that is, like, your strategy isn't always going to be firing on all cylinders. It's just not. No strategy is. And anybody who tells you their strategy always works is a liar, because they just don't work all the time. But as what we see here in NVIDIA is we start this wedge drop, we come up, we get the cross back here. To me, this is the little basin break that we break down from. This ends up being the reversal extension. You don't know that at the time. Not a shocker. It's right around this 200 period moving average. We trade up, we get the volatility contraction, which is key. And then what happens? We trigger a wedge pop here at around 130. And once we follow through, once again, notice the gap. Notice the gap. Another thing I'm going to really be drilling this home on the buying setups days is inside bar, gap. One inside bar, it's like a sign of a contraction in volatility. Often you'll get buy areas after inside bars on very light volume, which is exactly what we saw here. And sure enough, it also lines up with sort of like sort of lines up with kind of a, descending channel here. And when we take this out, that's the wedge pop. When you kind of trigger here, your stop might be down here. But I think once you take out this pivot, you can move it to the low of the day. That's how I would play it. And then sure enough, what do we get? We get a second gap up. That's a sign of strength. And as you work up, pull back and reconfirm, you're raising your stops up to this 137 area. Sorry, we're over here. It's 137 area. Go up, pull back, confirm. And again, I wouldn't want to be moving my stop up here yet, but then this is a major ignite bar on volume. So then you're moving your stop up for sure, because you get that ignite bar. You should not lose that day's low, especially if it's on volume, because anybody who bought here, when you lose that low, they're going to want to get out. So we go up. To me, zero chance I would have thought that this was going to fail here. To me, this would be the first extension. I'd be expecting, some more chop type action and then head back higher. But, it doesn't work out. We have a wedge drop here. But even for a trade that really isn't maximized, you still took about a 15% gain. We all want 50 to 100% gains, but it doesn't always work out the way you want. So to me, this was the first extension. It wasn't the second extension. If we were to go look at the weekly, you'll see that. So here's the weekly. This is kind of the first extension, and things don't always work out. Again, I hope you see that the strategy in and of itself isn't perfect, but it will work if you apply it over time. So okay, we don't make as much as we want here. You get a wedge drop, you get a cross back. This is kind of the basin break, and then this is, I guess, like it is the reversal extension, but it's a little more muted. And then what do we get? We get a tightening in price action here. And this is a really good trade for me. This is like the pivot clearly to me, right in here. Few subtle signs. I'm going to go over this more on the buying area, but this is a bullish counterattack bar. You can learn about that in the candlestick book, but we gap down and buyers buy it up. Basically, the reason it's called the bullish counterattack, big gap down is bearish, bulls counterattack, and they show, we're going to buy this market. And then when you get the gap up here through the pivot, this was the wedge pop trigger. And then the really great thing that we saw here, and you know, at the time, if you were following me on Twitter, I pointed out second gap, third gap. These are what I call power gaps, just gap after gap. You saw this in Tesla off the code lows. You saw it in NVIDIA here. And then is what happens is we put in a bull flag. We actually had earnings right here. And a lot of the time you want to see a stock blast higher on earnings. So to me, this was kind of a unique day right here in that we basically did nothing on earnings for NVIDIA, which was kind of weird. But this actually ends up representing to me the crossback. And this was another buy area in that we had a bull flag here and we broke higher. And, you know, this was a very good buy area. We broke higher, we trend up. One of the things that I actually personally did here, because I'd had so many names kind of just flop on me, is I drew like a resistance line here, and I actually took some gains on NVIDIA here, which was a mistake. But the nice thing is it showed me it was a mistake, and I was able to get back long here. But if you just follow the rules, we go up. To me, this is a basin break. We set this up, kind of a second bull flag. This is the first extension on the daily chart. I think it was reasonable to take some off here, actually. And the reason I say that is this is the first extension on the weekly. This could be interpreted as the second extension on the weekly. But we pull back, we find support on the moving averages. We set this up, but notice how the price action is so much tighter here and it's starting to loosen up a little bit. And is what I had drawn here on this chart is a trend line, I believe from right here all the way up. And when we got extended up here again, notice this candle right here, the hanging man. So always pay attention to the hanging man. Here's a hanging man candle, second extension on the weekly in this area. And then when we gap up and get a bearish engulfing, I think you'll see that a lot where you kind of have a 2 candle combo where you'll have this and a gap up that gets sold. And I actually did take my profits on this day, but you didn't really necessarily have to still get this trade right. You know, let's say that you got in on the wedge pop here and you sold on the wedge drop here. You know, we pull back and hold support. And then right here, when we lose, you know, this is the clear sell signal. So let's say that you got in here at, you know, 144 and you got out here at 197. I mean, that's a really, really good trade. You know, what is that, like a 30% gain or so? So, you know, these are the types of trades that I'm trying to make. And because this was the second extension, I actually was able to kind of avoid NVIDIA through here. I will say that this was, to me, a buy area right here that quickly failed. And it's not a shocker in that we had earnings, but this was the next good buy area after earnings. When you take this area out, and really it got stopped on this wedge drop here, and it just hasn't really worked. I will say that I got long NVIDIA in here, and I added in here, and I think that this was a wedge pop. The stop area is really, to me, kind of below right in here. You know, it really shouldn't lose the 50-day. And is what I'm looking for is I'm looking for, you know, this 10-day to kind of overtake the 20-day here, and either tighten in here under this trend line and then create a second buy area, which I think would be a good buy area or an add area, or maybe go up and then pull back and put in the cross back. That's kind of what I'm looking for in this stock right now. And that is, kind of how NVIDIA has played out this year. I think you can kind of see, how everything went down. But Richard, are there any questions there?
I there nothing super specific on Nvidia. I think a lot of questions I'm seeing have to do with how to tell when a stock is extended from moving average. I know you touched on this a little
Yeah.
bit, but can you talk about the different time frames you use, daily, weekly, and monthly, and what you kind of consider extended? I know it's a visual thing often, but yeah, could you go into that?
Yeah, so I think some little, sort of minor rules you can have for yourself on the NASDAQ is when the QQQ gets, 4 or 5% above the daily 10 EMA, it's usually going to either need to consolidate through time, meaning it's going to go sideways, or through price, meaning it's going to pull back. And likewise, on the weekly, if you get 7 or 8% above the 10 week, I sort of feel the same way. So another way you can kind of use the index is if you think we're potentially getting extended on a stock and the index is also kind of hitting one of those specific rules, or that's not really a rule, but let's say the index is like 5% above the 10-day, and you think that your stock is also putting in the second extension on the weekly, and is a little extended in its trend, then you can more likely act on how you're analyzing that individual stock, because you kind of have that, index uh, threshold, or whatever you want to call it, to potentially support that. So I do think that's another way you can use the index. But again, for individual stocks, it's open to interpretation. It's not an exact science. Something like this really doesn't actually look that extended to me. But it's more just knowing that it's the second extension on the weekly. And I'm sort of the kind of guy where when we start to get about 8 weeks into the trend, I sort of start to like to book some gains. Some of it's feel, which just comes with time. Um, so I don't have an exact answer, unfortunately. That's just the truth. I don't have an exact answer. Um,
It's the art in the chart. It takes time to, and it's
yeah,
knowing the character of your stock a little bit too, and looking back in time.
exactly. Knowing the character of your stock is massive. So, what's another real big extension we saw lately on a stock? Like this stock moves even compared to Nvidia or something through all this, it's much more volatile. So the extensions are going to be further from the 10-day, just because like that's the character of the stock. Whereas, I mean, Pfizer had like probably the biggest move in the history of the stock.
Yeah,
And how far did it get from its 10-day? It got pretty far for Pfizer, but it got about 8 to 10%, which really for a growth stock starts to be extended, but it's not like insane. You could see growth stocks get far more extended than that. So you have to understand the character of stock. I can't emphasize that enough. But then also taking into account where you are on the weekly. And then you have to understand that you're not always going to be right. And that's just, how it goes. You're making decisions, with the, you're looking at everything with all the information you have, and you're trying to make the most calculated decision possible. And, the thing that's tough with trading and the way that we're kind of wired is I think most people like to make decisions, with all the information, and 99% of the time all the information isn't there,
right.
when it comes to trading. So you just have to make your decisions and live with them. And that's trading. That's how it goes.
And there's a question about whether you trade cryptocurrencies, and also if the price cycle applies to that market as well.
I think you can use the price cycle on anything that trades. If human beings are buying and selling it, you can use it. I can't say that I really like trade crypto. I do own some crypto that is just, I try not to look at it actually.
Long term account, yeah, yeah.
Yeah. But I think you can see it. Go analyze the Bitcoin futures, and you can see that it works. I mean, here's an extension, and I'd be willing to bet if you looked at the weekly, definitely here this would be the second extension. And really, this move in Bitcoin was pretty crazy. It just kind of ground higher. But I don't think it's a mistake that we had a more drawn out correction after you get like this
Three,
is
four, yeah.
this is a fourth extension,
Right, exactly.
third, fourth. I don't think it's a mistake that you get a more drawn out correction after that. And what do you see? You get the wedge drop. To me, this is like the cross back. This is your extension. And this is very volatile, but the cycle works on Bitcoin for sure.
Perfect. And it's not super related to today, but there've been a lot of questions about how you trade or not trade during a bear market or extended correction, a 2008 situation or something like that.
So I was not trading in '08. I was playing football and enjoying college. So I can't really say if I'm being I can't say. There's people with a lot more experience than me. I'm still actually very early in my career. I would say for me at the time, the worst market I went through, and I think it was kind of because of what happened to me. This looks like nothing in 2011, but I was actually trading at a fund that did international arbitrage, and we traded a lot of commodity stocks like BHP, Rio, things like that, the Aussie dollar, which really got smashed during this time period. And I actually handled it pretty well, but I can't say it's because I had any real experience. I had been trading for about a year or two, and I did happen to be short the market here. But the firm I was at also went out of business, and I lost my job. So that wasn't great. But I would say probably the biggest corrections I've been through have been here in 18
20, yeah.
and in 20, and I've just followed the cycle. I think in 18 I was still kind of developing the cycle. I more just sidestepped this because I got stopped out of everything versus I had this like really defined strategy that I really, really, really knew. I was using it, but was just starting to develop it. Here, I was able to easily sidestep the COVID correction because every part of the cycle like played out. There was never a reason to get long the market at all. I think like maybe if you want to be really aggressive, you could have tried to say this was the wedge pop. But you're pushing it a little bit because you hadn't tested the 20 EMA. So for me, this was easy to sidestep. I think most bear markets with the cycle, you're going to be able to stay out of harm's way. And, even with, this year, where is it? Sorry. We're having a correction here, and I think that following the cycle kept you out of it, but more importantly, I think it's getting you back in,
right.
And we'll see what happens. I have no idea. All I can do is try to let the cycle tell me what to do, and right now it's telling me to get long, and we'll see where it goes from here.
Perfect. I think we'll take another 5-minute break and then come back and finish strong with Amba, and then answer a ton of questions, I think. How's that sound, Oliver?
Yeah, that sounds good. So I know people ask me this all the time on Twitter, so maybe a good time to answer it. So I use Thinkorswim for my charting, and then I execute through Interactive Brokers. I really love Thinkorswim. I think it's a great product. If I were strictly just trading my own money, I would probably use Thinkorswim. But I moved to Interactive Brokers for my executions for other reasons. But that's what I use. I know people ask me that a lot. But I will say too, I think a lot of people focus a ton on their charting software and am I using the right software? And I really don't think it matters. that
they're
much.
they're tools. It's
Yeah.
the methodology and the concepts behind what you do that really matters. And like in the chat, people are asking a lot about individual names. The concepts we're kind of talking about in this webinar, in this entire series, they're about trading. It's not just about UPST right now or net right now. They're going to be applicable throughout every market cycle. And that's what makes this super super valuable. And we saw it applies to Bitcoin as well. So it's just about trading, psychology, and managing risk, all of that.
Yeah. So like, and actually, really good question on the bear market in '08 before. And so something that I've done that I highly recommend you do is go back and look at the '08 top.
Mm-hmm.
Go back and look at the bear market from 2000 to 2003, and literally like mentally try to trade whatever your strategy is. If
Right.
it's my strategy or whatever, and try to be as honest with yourself as you can as to where the buy areas would be. And if you're honest with yourself, there's going to be a lot of buy areas that don't work. And I would recommend doing that through the previous market tops, through previous market bottoms, go through thousands of charts and, try to apply the concepts, because I've done all that. Like I do that every week now. So definitely want to be doing that to hone your skills.
It's like extra seat time almost. Like even though you didn't experience it, you can kind of think about, visualize how you would have handled the situations like that. And often it's a lot harder than even you think about it than you think it is, honestly.
Yeah. And so like every cycle is what I do. All the kind of best names, I write them down throughout the cycle, and I will go through and try to find, how did I miss this? How did this stock not show up on my radar? What would have triggered the long signal? Whatever I can do to try to get better, every single cycle. You got to do that.
For sure. All right, I think we're good to go. Let's go ahead and get started with AMBA, which we're going to look at intraday and really show kind of how you buy it, but we'll really go super in depth in obviously webinar 3, stop loss management, position management, all of that. So this is just kind of a teaser for that webinar.
Yeah, so I just wanted to show the cycle on a lower
Yeah.
time frame, because I know that I've said that it's fractal and it works on all time frames, and it does, but I figured we would give an example. So I like to focus mostly on the daily chart, because I don't want people to get like so lost on kind of the intraday noise. But I did want to show one example. So AMBA overall, we broke out of this huge base. This was the first, real buy area on this Bible gap up. And we go higher. And to me, is what's happening here is this is kind of a basin break right in here. So I'll zoom in here. You have this little descending channel into the 20 EMA. This was a buy area kind of with confirmation right here. And kind of the rules would be your stop would be here. And I actually had this, and is what I did is I raised my stop to here, and I got stopped out, which, that sucked. But, but it is what it is. But it's what I did is I realized, maybe the market just wasn't quite ready yet, or the stock wasn't quite ready yet. And when we came back into this 20 EMA, I wanted to see if things would hold. So even though I was stopped out, it is what it is. I didn't consider the stock broken, but I wanted to kind of see what happened here at the 20 period exponential moving average. So is what I did is when we came down into the 20-day, I was looking at the 15-minute, and just to kind of show the cycle playing out on the 15-minute, leading into this pullback, we got the wedge drop right here. We got the cross back right here. To me, there wasn't a true basin break, or maybe this was the base, cross back, maybe this was the basin break right here. And we came down and we're hitting the 20 EMA right in here. We're extended from the 10 EMA, and we go up, we tighten, we kind of contract the vol, and we go up and test the 20 EMA. And what do we get right here? We get a wedge pop. So I actually played this long in here, on this wedge pop. You can have your stop down in here. And this is just an example of being able to look at a level on the daily chart that you want to execute on and try to zoom in to the intraday chart to try to manage your risk. Now, that's not always the best thing to do, right? So you can move into the intraday chart and tighten your risk and potentially take a bigger position size, which is, really the way that I try to do things. But you're also going to have more whipsaws. So it's worked here so far in AMBA. But I always want to highlight that there's trade-offs to everything you do. So if you move into the intraday chart and maybe it goes up and comes down, stops me out, and I'm all pissed and I have to buy it again. That happens. That's a trade-off of trading the intraday chart. But I want you to see the cycle does work on the intraday chart. And often is what you'll see at bottoms is you'll actually see, I can't really show the 5 minute because I don't have enough bandwidth, but right in here, like this was a 5 minute wedge pop, guaranteed. 5 minute wedge pop. And what happens? We'll stall at the 15-minute EMAs. And then we'll have a 15-minute wedge pop. And often is what'll happen next is you'll stall at the hourly EMAs. So in this instance, we actually pushed through them, but we did pull back. And to me, this is really the hourly wedge pop. And then is what'll happen. The hourly kind of paired up in this instance with the daily. But now we're going to kind of consolidate, in my opinion, on the daily time frame. And I'm certainly hoping, because I'm long this stock, so we'll see. But I'm hoping we can kind of do something like this, and then head higher. So you turn trend on the lowest time frame, and then you turn the EMAs on every successive time frame after that. So often, if you're going to try to buy on a lower time frame, you should expect it to turn. You buy the 15-minute, then it's going to have to, turn the hourly EMAs. You buy in the hourly, then it's going to have to turn the daily. In this instance, we're already above the daily EMAs. So we're looking to use the lower time frame to get in on an already uptrending strong stock. And to me, that's exactly what you want to be doing. In normal environments where you're not in a 20 to 30% correction, you want to be trading stocks on their highs that are leading the market. And you can look to get in and execute based on a lower time frame to manage your risk. That 90% of the time is what I'm trying to do.
Perfect. Let me see if there's any questions. If you do have any, drop them down below in the chat and in the Q&A section here. And there's a good question here. Are there times when you don't trust a gap up, like you've got a gap up here on AMBA here, on obviously on the daily here?
Yeah. So when you have a big gap up, one of the main things that you want to have that can help you trust that gap up is a catalyst. So if we were just gapping up here on AMBA, because like let's say the market had a big, and this is a pretty significant gap up, but let's just pretend the market's having a big gap up and AMBA happens to be gapping up with the market. But AMBA has no specific catalyst and anything. I'm going to be a little bit less hesitant in trying to buy that gap up, right? Now, in this instance, AMBA has a big base, right? And you can kind of draw, this pivot point right here. So it's a significant level and it has earnings. So earnings is the catalyst. And to me, that's why you get this massive volume and is why this is a gap up, worth paying attention to. So I think having a catalyst is something that's very important.
Gotcha. Let's see. There's a question about your stop loss on the intraday time frame. Let me find that. Yeah, what would be your stop for your entry on the 15-minute on 10/12?
10/12. Is that's Tuesday? That's
I think they're talking about on this low time frame where
Yeah.
you place your initial stop. Yeah.
Yeah. So like that's the thing is I follow the rules of the price cycle. I just follow the rules on a lower time frame. So, let's say you got long here, really here, I guess, through this pivot, you know, you could do one of two things. You could give it the low of the day and you're giving it, an extra $1.50, or you could use this area. For me, if I'm going to use the low of the day, is what I'll do is I'll take a smaller position, like a partial position, and then is what I'll do is I'll look to add to it. And that's actually really what I did here in AMBA is I took a partial position here. I used the low of the day because I thought it was such a strong area on AMBA. And then I actually added on the open here because I thought that I wasn't looking at the intraday chart. I just thought we were going to follow through here.
Mm-hmm.
And I actually added there. And is what I did when I added is I raised my stop to this 150 area mm-hmm. so that I basically had no risk on my initial shares. And I had about 2% risk on my additional shares. So I still had risk. And, that's just how it goes. But it was able to work. And, kind of once you get this move up here, is what I'll do is I'll definitely move my stop up to this area. And then kind of once we had follow through here, I'll move my stop up to here, which is how I'm treating AMBA right now. Now, I personally would really not want AMBA to lose this. Oops, sorry. I don't want AMBA to lose this area right in here, right in here, because I think it's like a pivot that's significant. But I could see it, coming down and maybe trading a little below it and going back up. But what I kind of do is I have what I call a max pain stop. And that's like, if we lose 155, I don't care if we're extended to the downside of the intra chart or anything, like I am gone. Like I'm selling the stock. That's my max pain. Now, if we kind of come down and come around here and we rally back up and then we roll back over, I may have moved my stop up somewhere in this range, but that hasn't happened yet. So I'm just kind of waiting. I'm waiting to see what happens with this stock. I really just don't know. And that's kind of where I'm at.
Right. Let's see. I see a couple questions about wick plays and those type of tactics. We're really going to get into depth with those in webinar 3. This is more focused on the price action here. And also stop loss management, I think we'll cover really in depth. But let's see, I'm looking for questions about the price cycle here with AMBA. I'm not seeing too many in particular. So I think unless Oliver, you wanted to cover some more concept with AMBA, we'll just move on to the Q&A if that works for you.
Yeah, that's all I had to go over. I just wanted to give an example there. And I encourage you to go back and look through lots of different names and try to identify it yourself. But yeah, let's move to the Q&A.
Yeah, and before we go to the Q&A, we did kind of assign you some homework here in your notebook. It's to mark up UPST with the price cycle. So basically, the instructions is to do it out on paper, take a picture, and share it on Twitter, and we'll give you some feedback as well. Before we get into some general questions, and drop them down below, guys, if you have any on this entire presentation, all the material. I think I just want to kind of ask you, Oliver, what do you want the main takeaways for people watching this webinar 1 on the price cycle? What do you want people to walk away, like basically, what do you want their big takeaways to be walking away from this webinar?
Yeah, so I think like understand that price moves in a specific way, and there's different, like you bottom and top on volatility, and then understanding, generally speaking, the movements in between those bottoms and tops. So kind of the way that I use it is, compare the weekly with the daily to help you make better decisions on the daily, my trading time frame. But then, if you get a wedge pop and, I know a lot of people tell me on Twitter, I try to help people the best I can. And they'll say, for example, I'll give you an example on AMBA here. A lot of people ask me, did you take any off here? How did you not take any off? And, my response to that is, I think that this was like the buy signal. and I'm not looking to take like 5 to 10% gains. Like I'm trusting the cycle, and I'm trusting that if this trade's going to work, it's going to pull back and support itself. So I'm comfortable uh, holding, and I'm at peace with the fact that it may not work.
Right.
So I think if you can kind of understand the cycle, and if you think about the fact that the index has just had a wedge pop, and you can be content with the fact that, you know what, this wedge pop may not work. It may fail and not work. And, you know, I may give back my gains. And that's part of trading. Like nobody knows what's going to happen. But if you can be content with the fact that if we see a follow through on this wedge pop and we put in a crossback, you know, I may be on a name here that I've got my risk managed on, right? My stop is in the money on this thing. And if it works, like who knows, this thing could be at, you know, 200 within a couple weeks. And that is where a guy like me does well, is when we start to see the price cycle work out. So is what I would tell people is try to get comfortable with the different steps of the cycle. And when we're early, like if you get a wedge pop and you're positioned well in the market, you know, try to have the confidence to hold through those different steps, versus if you're buying after the second basin break, you know, try to also have the discipline to recognize you're later in the cycle and you do want to treat it more as maybe a 2 to 3 day swing trade. And then understand where everything is within context of the weekly, as far as when to be aggressive and when to, you know, be more aggressive in taking profits. And then lastly, understand that things don't always work the way we want, and that's trading. I mean, you can't just switch your strategy, you know, every 6 months because, oh, you know, Oliver's strategy, you know, it's been choppier and it hasn't been as good or whatnot, because then you're going to miss that next big trend. And really, you only actually need to catch one big move to make your whole year. And if you catch two, you can have a massive year. And
Right.
if you catch three, which, you know, there's just not really time for more than three, but if you catch three, you know, you can really, really knock it out. So I would encourage people to just get comfortable with whatever strategy that they want to use. Pull pieces from this, pull pieces from other people, and stick to something that you can build. And, you know, if you can trade a strategy when it's not working well and still make a little bit, and then crush it when it is doing well, I mean, you're going to do really, really, really well over years versus months.
Perfect. That's an awesome takeaway. To start things off, as people enter their questions in the Q&A section, I think I've still seen a bunch of questions about the wedge drop. People, I think, want a little bit more clarity on the specific point here and maybe the pivot that you're looking for. So maybe you could bring up an example of the Qs now or Tesla last year and kind of talk through the wedge drop one more time.
So yeah, I mean, the wedge drop is you have
Oh,
some
the
sort of
wedge pop. I apologize.
the wedge
Wedge
pop.
pop. Yeah.
So the wedge pop is really when, you know, we've gone through the cycle to the downside. So we had the crossback, the basin break, our extension. We came up and retreated, and we saw contraction and volatility. And then for me, is what I did is I created this as a pivot. And the reason I did that is I kind of looked at this big sell down bar. This was where it opened. It kind of aligned up with here. And so that to me was the true trigger. Now, I was kind of looking at this overall pattern in general, and this is where just kind of understanding and studying technical analysis in general can help you. I was kind of looking at this as a potential inverted head and shoulders bottom. This is kind of like a flaggish like pattern, and I did anticipate this. But the only reason I anticipated this is because of the setups in underlying stocks. If there were no setups in stocks, I would not have been anticipating this at all. But, you know, that's really what I'm trying to do is find a pivot. And, you know, if you look at some of the names we went over today, and I mean, we can go through tons of these, you know, this is kind of the pivot on NVIDIA, right? Currently, if, you know, we look at some of the other previous ones, you know, this is kind of the pivot. it's kind of at your discretion to make the pivot. But notice the descending channel here in the video. So like we have a pattern, and we're really looking to create a pivot to bust out of that pattern. And I'm going to talk about, identifying these patterns more on the buying session.
Mm-hmm.
But that's what you're trying to do, is identify some sort of pivot that, you can say, hey, if we trade through this pivot, we really should follow through on it. Whereas if we were to go up and come back down, it's kind of like the pivot just isn't working, and the trade may not work. So in my head, I'm a simpleton
Mm-hmm.
where I want to say, if we trade through 143.50, I expect this to go higher. And if it doesn't go higher, then I think I'm wrong. And that's kind of how I am. It's funny, I'm working with a guy right now who I'm friends with, who I didn't even like, when I try to teach people, I try to say, you want to buy here and, have a stop down here or something, just because it's simpler. And he goes to me, Oliver, I've created this new concept called pivot manipulation, where if we trade through the pivot and it fails, I get out. And honestly, guys, that is sort of what I do. It's hard to explain that concept to people, but you're looking to identify areas where you expect price to do a specific thing.
Right.
And if it doesn't do that, then you may not necessarily be wrong. It may just not be ready. That's like the Minervini concept of squatting.
Yeah.
But I think when you're buying patterns, kind of what I'll call in the pocket, you should really see follow through versus squatting. I think squatting is something that might happen up here more, where more people are looking at it. I don't think as many people are looking at these patterns down here the way I am. I think most people are, looking at this. They're looking like right at the highs. And I think that's where you can get some more gamesmanship. Whereas off the bottom, most people that are buying here are institutions. And so you should really see follow through on that pivot.
Perfect. Yeah, I see some comments that it's much clearer now. Awesome. So there's a question here from Pradeep. When does the cycle get reset and start over?
So the cycle gets reset, either on a exhaustion extension, but really the confirmation. So right here, there's not a definitive blow off.
Right.
But to me, this is a wedge drop. And so this isn't the best example because the cycle doesn't play out perfectly. But to me, that's like the step aside and wait for my next opportunity type signal. So the cycle resets really on the wedge pops and drops, because those are really the confirmations of the reversal extensions off the lows and the exhaustion extensions off the highs. If you can identify wedge pops and wedge drops and only take those signals to get in and out, you'll do really, really well. And then I think as you get more experience, if you can specifically identify the exhaustion extensions, because that's going to help you sell into strength better, you can improve a little. And then to me, I don't think you necessarily need to identify the reversal extension as it's happening. You just need to pay attention, because I'm not trying to pick the low here. I just want to, when we get up here, I want to be able to say, oh, that might have been a reversal extension. Okay, let's keep an eye out for volatility to contract, see if I can find a pivot, and then let's look for the wedge pop. So I think if you can identify the wedge pop and the drop first, and then with time be able to better sell into strength, I don't think you necessarily need to know exactly when the market bottoms, when it's happening.
And there's a question here. Does the wedge drop need to coincide with a stock going from above the 10-day EMA through the 20 EMA, I guess? So does it have to coincide with breaking below those moving averages?
No, it doesn't.
It's the price action.
Yeah, it's the price action. So like, for example, like this pivot right here sets, sort of around the 10-day, right? Mm-hmm. Whereas, we could probably find other examples. This right here is more kind of around the 20-day. So it's just kind of how it sets up. I think more importantly is one, finding the pivot for both situations, and then two, kind of understanding where the weekly is. So like if we're having the second extension on the weekly, like you want to be more aggressive in one, playing the extensions, and then two, definitely respecting the wedge drop if the weekly is extended. Because if you go through thousands of charts and identify second extensions on weeklies and then find the wedge drops, you'll see the sell downs are much more aggressive when the weekly is more extended. So really try to identify where you are on the weekly, and then let that kind of help you, play the signals on the daily.
Perfect. And here's a question from Jack. How's it going, Jack? Does Oliver have any insights to when a consolidation is too tight for too long, or do we only know after the fact?
So this was something that JT from Ticker Monkey, it's funny. I remember specifically when we kind of came up with this. It was in Lulu, actually. I can't even remember exactly when it was. It was years ago. And we saw Lulu, just like it was an obvious pattern. We were all along the name, and it failed, and we all ate it. And it's kind of when we came up with the concept for too tight for too long. There's actually no set rule on it. It's more a feel thing, where you're in a position and you're really expecting it to get going. Then I almost think when you're in a name and everybody's talking about the setup, and then like a day or two goes by and it's still not going, and like then more people start talking about it and it's still not going. More the way I approach it is I just think of it like, okay, everybody's talking about this thing, and let's say it takes out the bottom of the pattern. I'm out quick, because I'm thinking like, oh man, this thing could really unravel. So no, there's no set rules around it. And maybe it's what I'll do for the next session, or I'll put out on Twitter. I'll talk to Jason about it and see if he's created some firm rules on it.
Cool.
But yeah, there's no set rules. It's more just a thing to be aware of.
Perfect. And on the wedge pop, when and where do you enter on a gap up? Are you looking at an intraday basis? Are you just looking at that pivot? How do you manage that?
So it's tough to answer that. It's sort of dependent on. Sometimes I just have a feeling and I go for it, like right on the open. That's just the honest truth. If I can, oftentimes I think a lot of wedge pops they almost sort of trigger near the open. Like I know this one definitely did, because it's almost like there's just this, a spring's been pushed together and it explodes on the open, and you kind of have to just be ready for it and go for it. With that said, if we had something where I could find a pattern on the intraday, I would definitely be looking to play that intraday pattern, and it just kind of depends. So, for example, on this situation, we had the bullish counterattack and then the gap up, and I felt like this was a fairly defined pivot. So, if you're not sure, another way to manage risk, really probably the best way to manage risk, is there's an old saying, what is it? Price hurts, but size kills. And is what that really means is, let's say you go out and you buy like a massive position on the open here and it reverses, like that's really, really going to hurt you. So if you're not positive, one thing you can do is take a partial position, give it a little more room. Maybe you decide to give it down to here, and, so you're giving it like 2.5%, but maybe you start with a partial position. And then as you start to see things work, maybe you add to it and move your stop up. So it's hard to answer that because each situation is different for me. Sometimes I just like have a lot of conviction and I go for it. Sometimes I'm really looking to play the intraday pattern. But I do think the wedge pop, because a lot of them have this gap up and go characteristic to it. It's a little different than some of the other patterns where maybe you're buying a pullback and you're looking to find an intraday reversal or something, and you are using the intraday chart. The wedge pop is the one scenario where, maybe you just go for it when it takes out the pivot.
And a couple of people here are suggesting PLTR as maybe an example of too tight for too long. Let's see if that's the case. I know a lot of everybody was watching this stock pretty much
Yeah.
um, before
So
the breakout.
I did really well in this stock here.
Yeah.
And I actually have completely taken this stock off my watch list. I just have done terrible in it. Um,
So that's kind of the second extension on a weekly. It looks like if you go to a weekly chart.
so I think that Palantir had a blow off top personally, like
Mm-hmm.
first extension, second extension. And I think look, I thought when we were taking out this area right here, I really, really thought this thing was going to go.
Yeah.
I really, really, really did. We had the second extension and we had a more drawn out base, which is exactly what you would expect. So, like, I don't think it was a surprise that any of these, I was not paying attention to Palantir here at all. I think I did start paying attention to it more in here. I kind of got shaken out and, stopped out. And then in here, I had actually taken it off my list just because I just hate this stock. I think it's so crowded that it's tough to trade. Um, but too tight for too long. You know, I don't actually really, really see that on this name. Um, I think that this is a blow off, and yeah,
Yeah. Yeah.
this could be a wedge pop right here in Palantir. So if I was interested in the name, this would be a pivot I'd be looking at, right
Mm-hmm.
in here. But I think overall, there's much better opportunities. Like, think about the fact that we just had a wet, how I said, like, you don't want to be behind the market in the cycle. We already had a wedge pop in the indexes and Palantir did nothing. Like, this is a laggard stock. So in my eyes, this could have a wedge pop here. But I would envision it being, a stock that maybe goes up to this level and then rolls back over again. Could I be wrong? Sure. But I think it's shown relative weakness to the index, and it's not on my radar. One, because I just hate the stock.
Yeah.
But two, I just think that it's shown weakness. And even if it works, I think there's other stocks you can buy that will work a lot better for you.
Yeah, I think that's a great point, and something people should take away from this webinar is you want to be looking for leaders, stocks that are ahead of the market in the price cycle. I think that's now I saw a bunch of people saying like that was like a golden nugget in the chat. So yeah, that's a key thing to remember. And PLTR right now hasn't had the wedge pop the market has, so kind of by definition right now it's a laggard.
Yeah.
Let's see. Okay, yeah. This is a something that I saw a lot of people have issues with. Any chance we could go over the EMA crossback versus the base and break and the main difference between those two stages in the price cycle?
Yeah. So the the first main difference is here we can look at any stock. Let's look at Zoom. Um, so in Zoom, you kind of got moving here off the lows, and unfortunately, it stopped out here, and then it had another wedge pop here. And to
Mm-hmm.
me, this was the crossback. Now, characteristically, I think the crossback will often be a shorter pattern. Maybe just a little pullback and then continuation. In this instance, it did put more of a little mini base in and then go. But really the only thing that I can say is the crossback is just the first pullback to the EMAs. And because it's the first pullback kind of off that first thrust, I find it to be a more shorter term,
Mm-hmm.
uh, pullback. But that's really the only difference, is it's the first test of the EMAs. I just identify them differently for myself, because I want to kind of have different steps of the cycle in my own head, so that when I know we have that first basin break, like I think we're kind of at the midway point, when we have that second basin break, I'm like, okay, we're getting to probably the second, third part of the cycle, and I want to start looking for red flags. So that's really kind of why I call it something different, is just because it's the first test of the EMAs. And then I want to have something where in my head I can say, we're getting later in the cycle, just so I can more change my mindset.
Gotcha. Gotcha. Um, let's see. Keep the questions coming, guys. Let's see. How do you know when a price breakout? How do you know when a stock breaks out and is not extended? And or do you wait to pull for it to pull back and form a base and break? That's from Gabriel.
So I'm trying to buy here. Everybody's asking about UPST.
Yeah.
I'm trying to buy stocks like when they're breaking out. So I'm going to go over this type of buy area on the buy session. It's unique. So I don't want to go over that here. But this is a bull flag in UPST.
Mm-hmm.
And then this is an inside bar. This is actually a true wick play here, and that this is inside the wick. It's a huge, huge signal. And when we take out this high, this is the buy area. So like I'm trying to buy between 206 and like 208 or so. And as it follows through, I'm actually, initially my stop is down here. And then quickly, if we see follow through, I'm putting it to the day's low. So I'm trying to buy at the pivot. And if it got up to here, like 215, 216, I'm not looking to buy there. I just consider it to be extended. Now, maybe you could buy this area here, but I try to not buy when we're too far from the 10-day.
Mm-hmm.
And I think that this was the type of stock where it was so strong that it wasn't going to fully come back to the 10-day. So this is one where, this is like that gap up or episodic pivot type concept.
Yeah.
Where maybe the 5-day comes into play. And I think that's why this bull flag worked. But I probably wouldn't be buying up here just because I'd be a little worried that it would shake out. Now, this right here is a good buy area to me at this 230-ish area because I feel like the 10 days caught up a little. This is an inside bar on extremely light volume. So to me, the buy areas on this stock were like right here, right here, right here, right here. And then, I personally thought this was an extension in this move.
Mm-hmm.
And I think this is a good example. This is like one of the strongest stocks where you pretty much, for me, I thought the 10-day was the relevant moving average here. So the 20-day, wasn't as relevant, even though it did end up holding here. But I think the next buy area, I personally tried right here and I took it in and then I bought it back in here. So I would have been trying to buy right here. In this instance, I might have been willing to buy up to like, 324-ish or so, just because there's like a pivot point here. But typically you want to be trying to buy as close to the start of the move as you can. And the reason I say that is because if you buy like up here and your stop is down here, you have a 6% stop. So that's okay if you really like it, but you're going to have to take your position size down because you're taking more risk.
Right.
Whereas if you were able to buy in here, your stop is about 2.5%. So you can, one, take a bigger position because you have less risk, but then two, your entire risk reward is skewed more in your favor. So let's say that we want to be looking for like 3-1. A lot of people say that, but I actually look for a lot more than that. But let's say you're looking for 3-1, now you can have a 7.5% gain and you're, matching that 3-1 ratio. Whereas if you pay up and you have a 6% stop, now you need an 18% gain to, hit that threshold. So you want to try buy as close to a pivot as possible.
Gotcha. And would you consider that to be the pivot of the base and break? Because it hasn't fully broken out of that high tight flag pivot, the all-time high it was at.
Yeah. So this to me isn't a buy area up here. This was the buy area.
Gotcha. A lower pivot. Gotcha.
Yeah.
All right, there's some really good questions coming in here. First, we haven't talked too much about the other two moving averages on your chart, the 50-day and 200-day. How do you incorporate those into your style? And also, does it matter to you where the wedge pop occurs? For instance, I guess probably it's all in context because during the March correction, everything was below their 50-day and 200 days. But in general, do you prefer wedge pop to occur above the 50-day?
In general, yes,
Yeah.
for sure. I think that the strongest stocks in a normal environment, especially, think about this. We had a 5 to 8% correction. I think it's safe to say UPST is probably one of the top 2 to 3 names in the market,
Hmm.
and it's above the 20 period moving average. I mean, this is a strong stock. AEHR, one that I was focused on and just totally blundered, above the 20 EMA.
Hmm.
And these are the names that are blasting higher. Now, Net is obviously a name that has absolutely crushed it, that lost its 50-day. And honestly, that's part of the reason why I missed this stock. I saw this down here just like everybody else.
Yeah.
I chose not to take it because it was below the 50-day, and I thought I could stay on other things. Apps is a name that has been really a good name that was actually below the 200-day.
Hmm.
The only way, and I've been interested in apps, the only thing I can say on apps is, I mean, it moved from 6 to 100 in like a year and a half. And if you zoom out to the monthly, this is a pretty sound pattern overall. So, maybe you can try something like that below the 200-day. But guess what on apps? If you didn't buy apps until it got above the 200 period moving average and you got in this area, I mean, what did you miss? I mean, I guess percentage wise, you missed a bunch, but the guy I've learned a lot from has always told me, for example, apps might not even be a big winner here.
Yeah.
This guy's always told me, and you could pick any stock. And for me, if we look at apps, if apps is going to be a big winner, it's going to clear 93.50 at some point in time. I mean,
Right.
you could literally be waiting for this stock until up here. And I can guarantee you, if this is going to take out 100 and fly to 300, it's going to create another buy area up here. So to me, you've missed nothing
Right.
in this stock. I mean, sure, you've missed 70 to 85, 20%, but who knows? Maybe this rolls over and goes back down. I have no idea. But so, yeah, if you can wait for stocks to be closer to their highs and above the 50 and 200 period moving average, those are always going to be the best acting stocks. And really, if you think about it, the best acting stocks, the whole reason they pull back to the 20 period moving average is because the market's in a correction.
Right.
If the market didn't pull back, UPST probably would have just kept going up. But the market pulled back, and the only reason you got the opportunity to even buy this thing down here is because the market pulled back. So why not trade those stocks that are pulling back to the 20-day? Why focus on the stocks that are losing the 50-day?
Perfect. And this is a really good question from Alan. In a choppy market, would you look at the price cycle as fractal, meaning you would apply similar techniques just on smaller time frames? Yeah, I get that's pretty much the question.
Yeah, like I think that's definitely something you can do. I didn't do a good job of identifying that this year, but that's definitely something you can do. Maybe you start making your trades more in the hourly chart so that you're taking your gains quicker. I think that's something that just comes with more experience as to knowing when to do that. The one thing I would just say is if you do that, you've also got to know when to switch back, right?
Right.
So I think it really just comes back to one, having the experience to know when to do that, and two, having being at peace with the fact that your strategy may not be firing on all cylinders all the time, and it's just the way it goes.
Perfect. And this is a really good question. Something that actually reminds me of something we talked about in the mock run throughs, but not here. During a correction or just in general, do you look at the slope of the 10-20 EMA and kind of judge when a stock is kind of shaping up and ready to form a wedge pop?
Yeah, I do. So I think that if you're looking to buy a situation where the 10-day is still accelerating down from the 20-day, the chances of that working are going to be lower than if the 10-day in the 20-day, the 10-day may still be below the 20-day, but it's no longer accelerating away from the 20-day.
Right.
I think often when the 10-day is really stretching down from the 20-day, you can get a big pop back up, but oftentimes it's just kind of like a squeeze. And the stock hasn't had the time to, really set up for that sustained up move. I'm sure we could find exceptions. I'm sure we could. But generally speaking, I think that's definitely something that I look for.
Gotcha. Um, and this is a good one. Oliver, could you rank the price action cycles by kind of success rate based on trades you've implemented since you've developed your style? So I guess taking a reversal extension versus the wedge pop versus the first EMA crossback and that type of thing.
Yeah, so I like to play the wedge pop, and the reason being is because if it does work, I'm going to be able to have a bigger upside winner. And then when we get later in the cycle and I'm playing things like basin breaks, maybe the first basin break I'm looking to hold more, especially if it's like a traditional buy area, like a cup and handle or something. But that second basin break, usually I'm treating that more as like I guess I'm swing trading all the time, but more as like a 2 to 5 day swing trade. Just because I kind of view it more as like we're getting later in the cycle. This is cash flow. The last thing I want to do is lose money on something this late in the cycle. So the wedge pop for me is the best pattern for me to trade. The caveat to that is, let's say we're coming off the lows in the indexes and there's a stock that has been working higher through the correction and it's actually building a basin break, like it's already like it's really strong. That is like an ideal scenario, because you have a stock that's so strong that it moved higher during the market pulling. Then in that scenario, you know, that's like the holy grail. That's an amazing situation when you have a stock that's literally blasting out to new highs as the market bottoms.
So kind of like Zoom last year, right?
Yeah, like I think like Zoom last year, like look at Zoom. So this is February. Zoom is like moving higher.
Right.
And I was trading this and it was tough because
It's
it was
choppy.
so choppy
Yeah.
because the indexes were so choppy, but this thing was like fighting higher, like it
Yeah.
was. But then, where around here, we kind of went up and it was still a little choppy. Just last year was just a crazy year. But really, once this thing unleashed, I mean, it rallied 50% in a month.
Yeah.
You can do pretty well with 50% gains in a month.
For sure.
So, yeah, I think that's a fairly good example.
And this is a really good question from Randall. What do you think the biggest mistakes that are easy to make when trading wedge pops and EMA crossbacks?
The biggest mistakes. So, uh, and look, this is like more because like this is my style. Like I'm comfortable buying a wedge pop and giving back some of my gains if it doesn't work, because I just have the self-confidence that when it does work, I'm going to make up for all the times it doesn't work. So I can only speak what works for, my personality.
Mhm.
But I think a mistake people can make is if they have like a really, really, really good buy area and, you kind of sell out too early. Now that's kind of been the play this year. But, I find if you can get a really good price at the beginning of a nice uptrend, the best thing you can do is nothing. Like my best trading is when I can get positioned and I can do nothing for like 4 to 6 weeks. And I don't want to have to be trying to catch every tick. I don't want to be the guy, look, there's guys that do this and they're awesome who sells the little bit of move up and then is able to buy the pullback. I would rather just hold my position through the move. Um, and I recognize sometimes that doesn't work, and I'm cool with that. So for me, I think the biggest mistake people can make is they have a good price and they don't maximize the trade.
Perfect. And this isn't strictly related to the price cycle, but I've seen a lot of people ask it. What's kind of your preferred time of the day to execute trades?
Sure. So I think the best times of the day to execute are, the first hour to hour and a half of the day. And then I think often is what'll happen. And, trend days are different, but, you'll kind of get that move. Sometimes you'll get like the 9:30 to 9:45 ish to 10 o'clock kind of false move.
Right.
And then you'll get the real move from like, 10 to 11, 11:30 ish. And then from like 11:30 to call it, 2:30 ish is kind of that midday, just nothingness, light volume chop. And then, and oftentimes you'll see people who lose their position right around 2 to 2:30. I mean, it happens to me. Um, and then you'll get that kind of 2:30 to 4 o'clock push. So I think the best times to execute are that first hour and a half of the day, and then that last hour and a half of the day. One thing I will say is the first half hour is tricky, because you can get false moves in the first half hour, and especially in like choppy markets, you can have like a big up bar on the 5 minute bar, and then they sell it off all day.
Right.
So I think unless you really have a hard pattern that you have a lot of confidence in, or like a catalyst, it's better to kind of let the market settle, that first 15, 20, 25 minutes, give or take, and then look to strike. Um, with that said, if you get a hard wedge pop and you think it's going on the open, it's a judgment call. But that's kind of what I think. You kind of have that first hour and a half session. You kind of have that 2.5 hour lull, or give or take, and then you kind of have volume will come back in that last hour or so.
Perfect. So if a stock breaks out and goes through a pivot in the first few minutes of the day, would you take it, or it's a little bit contextual as well?
It's contextual, but yeah, I'll take it. Yeah.
Perfect.
It's going to come down to whether I like, look, if I hate the market and I think like a lot of breakouts are failing, um, maybe I won't take it. But another thing that I said earlier, you can always take a smaller position.
Right.
You can always say, hey, I'm not sure, but it's triggering. Okay. Normally I want to take, it's different people take different position sizes, but for me, maybe normally I want to take a 15% position, but I'm not sure, so I'm going to take a 7.5% or something. Or maybe if you're a type of person who takes a 5% position, maybe you take a 2.5%. Um, and that's just a way that you can be involved if it's triggering, but you can also, uh, you know, hopefully be managing your risk if you think we're in an adverse environment for those types of situations.
Perfect. And Declan has a question here. What does Oliver think about trading long expiry options based on this price cycle strategy?
So I don't trade options. I don't. If I wanted to trade long dated options, though, like something like a leap, I would probably really be looking at the weekly, and I'd want to be buying options. I mean, it's easy to say I'd want to be buying options here, but I'd want to be buying options when like a weekly base is breaking out. Like, I personally, I wouldn't really want to be buying options long dated here, maybe here. But the only reason is just if I'm buying a long dated option, I want to be playing, if you've read William O'Neill and the stages of the bases, I'd want to be playing long dated options off stage one basis, versus later stage bases. But again, I don't trade options at all. So I'm probably not the best guy to ask.
Gotcha. Um, I see some questions. They're not super related to the price cycle. So daily routines, stock selection, all of that we're going to cover in depth in future webinars. So don't feel like we're ignoring your questions. We will cover it 100% just in future webinars. Um, and this is a good one from Luigi. On a bottom pattern, it seems that one needs to avoid a wedge pop after the first low and then try to buy it at the wedge pop after the second lower bottom.
Yeah,
Yeah,
I would agree.
yeah, there you go. Or you just get stopped out. It happens. Yeah, you
Yeah,
think it's gonna
yeah.
work.
You,
Yeah,
you take it, you get stopped, and maybe you have to give it another try. I mean,
perfect.
I take a lot of scratch trades.
Gotcha. Let's see. And there's some specific questions about buying setup. Once again, we've got an entire webinar focused on that. And there's some more on stock selection here. So I'm seeing not too many more questions on the price cycle. Oliver, do you want to take like one or two more and then we'll kind of wrap it up for today?
Yeah. That's whatever you think, Richard.
Yeah. And like we've said, we're going to take the most popular questions and make a Q&A forum in the course. So you'll see all those answers here. A lot of people are asking pretty much the same questions. So let's see. Let me find one or two more. For the fractal topic, Oliver mentioned that the trend starts to turn on the lower time frame and then start to turn on subsequent time frames, 15-minute to an hour to the daily. Any more suggestions on how to do that, or maybe go over another example?
It's really just, if you think about it, like you're gonna get a wedge pop on the 5 minute time frame first,
Right.
right? And then when it rallies up, is what I've found is that it'll often resist when it hits the 15 period
20.
moving averages. Yeah. And then it'll pull back and it'll build a wedge pop on the 15-minute time period. And then when that 15-minute wedge pop triggers, it'll often resist at the hourly declining moving average, and then it'll set up the wedge pop on the hourly. Now, does it always happen perfectly like that? No. But generally speaking, it does. So is what I'm trying to relay is that, the lowest time frame trend will turn first. And then you'll get confirmation by the preceding higher time frame trends turning. So if you're buying a pullback on the daily chart, you can look to execute and get long on the lowest time frames, and your earliest signals long will be on the lowest time frames. But you'll also get more whipsaws and false signals on those lower time frames. But as the trend starts to turn, if you want to try to play the 5 minute, and you're going to get a signal first every time, no matter what. But your chances of that signal working are when you get a confirmation signal on the next higher time frame. So that you get that confirmation signal on the 15-minute, your likelihood of it working increases more. And then you get that confirmation the hourly, the likelihood of it working increases even more. So it's kind of how I step out when I'm playing a stock. So let's go back to that AMBA example, because it's an example that I know recently. We saw it trigger on the 15-minute, and we could have gone up and tested the hourly EMAs and rolled back over. But when we went through the hourly EMAs, the chances of this working were very good, or at least from the perspective of working to the point where you could get out with at least a scratch trade. And then if we then move, so like when I'm mentally taking this, like when I get long, like it goes up and really, like at this point, my stop is definitely at cost, like once you get follow through the next day. So I definitely segment days too. But I'm not so much paying attention to this 15-minute wedge drop at this point, even though it does trigger. And like a day trader may be taking their gains, they may be taking their gains. Whereas I've actually already moved my position management to the hourly. And I'm more at cost, and I'm really just sitting there kind of like, well, I sure hope this thing works. Like I wish I could say it's like more to it than that, but kind of once I position, I'm more sitting there like, well, I really hope this works. And then to me, the hourly wedge pop is right here. So once we get that hourly wedge pop is what I'm doing is I'm moving my stop up to here, and we get a little follow through here. And in this instance, we follow through on this daily pivot right here. Then I'm moving my stop up to here. And then now what do? I'm stepped out and I'm managing this trade on the daily time frame. So is what I did with this is get in on the 15-minute. Okay, we punch through the hourly EMAs. Okay, let me step out and start managing this on the hourly. Okay, let me show let me make this hourly time frame a little longer here so you can see something. Where is the hourly edit? We'll make it 10 days. Add apply. Okay. Hold on. Sorry.
No problem.
All right. So let me go into this hourly and see how there's kind of this pivot right here on the hourly. See that? So that's the hourly wedge pop right there. Once that triggers on the hourly, now I can step out to the daily. So as what I've done is I've started my trade and managed my risk on the 15-minute. I've stepped out to the hourly as it turned the hourly trend. And then when I feel like we've done that to the hourly, now I have my stop up here. It's in the money. And now I'm trading it on the daily, which is really my goal. Like that's what I want to try to get to is the daily chart. And I think you see it. I've seen it, Richard, like a lot of your other interviews, like Salim actually talked about it on his interview this past week, where he mostly trades on the daily. Like I don't think he's doing as much intraday like I am, but he'll buy a breakout, and he's using it more at the moving averages. As soon as the 20-day gets above his price, he's using that, and then when the 50-day gets above, he uses the 50-day. I'm doing something similar, but I'm more doing it just based on like time frames where I'm trying to manage my risk on the lower time frame, step out to the hourly. Like I'm really hoping I can get to the daily, because then that's maybe where I can catch a real trend. So that's I don't know if that answers your question. I hope it
No,
does.
for sure. I think it does. I think for sure it did. To end it, we'll finish with a question from DV. He's talking about the SPY on 10.7. Is that a wedge pop that failed initially, but ultimately followed through on 10.14?
10.7. So to me, and actually DV, it's a good question, because I was sort of thinking that this was a wedge pop, and this was potentially your pivot. I wasn't positioned for this, to be totally frank. So I was sort of still just in wait and see mode. But I think that if you were to play this actually was a wedge pop that didn't fail, in the sense that it popped, and technically your stop would be below here. So I think you could have played this. I really did play this one more because I saw more stocks setting up.
Right.
And I felt like this was a better pivot, but I think this is a valid pivot. And I think it was totally reasonable to think that this was a wedge pop for sure.